Hello, this is Al Zmysłowski, AAII, Silicon Valley Chapter Board Member. What follows is a recording of the webcast of the chapter's October 7th, 2017 event on Adaptive Asset Allocation, Dynamic Global Portfolios to Profit in Good Times and Bad, by Adam Butler and Rodrigo Gordillo of Resolve Asset Management. The video begins with chapter announcements, which last about 10 minutes. Adam then begins the first part of his presentation, and approximately 1 hour and 20 minutes later, the mid-session break takes place. After the break, Adam kicks things off with a quiz, and then he and Rodrigo complete their presentations. On screen presently is Resolve's disclaimer. Please review this information carefully. We'll provide a short pause here to give you time to review the slide. At this point, we'll proceed to the rest of the video. Thanks for watching.
Now with the announcements. So first off, welcome to our new home, our new place where we're doing events. Hopefully we're able to find it, which is too painful. Item on for forever ticket holders, if you've got one of those, we're asking people to either mail those in, okay, so that we can reserve a spot for you, or worst comes to worst, email it in and let us know you're coming. And that's again just so we can reserve a spot for you. You can still walk in, with a forever ticket, but it's space available faces. So just FYI. What's coming up in November? We have our tax reform session. That'll be a full double-header session with Claudia Hill. She's very popular with regard to that. Let me tell you, the chapter's a little paranoid about this one. And that's because for years and years, we've been able to send out a mailer to everyone announcing that there is, the meeting for the month, right? Well, we ran out of mailers, or these free mailers, and they want to charge us like $700 to mail out stuff to everybody. We don't make $700 on one, to be truthful. So we're going to go without the mailer, the physical mail in November. However, you'll probably get, instead of the standard 2 email reminders, you'll probably get 3. 1 3 weeks ahead, 2 weeks ahead, and a week ahead. Okay. There are some handouts of the physical mailer if you want to get a physical copy of it. December, we're off. And then in January, we have Tumo Lampinen. His name is almost as bad as mine. That we'll be talking about. He comes out of Austin. He's a very interesting guy. I'm not sure, but I think Adam May and someone might be using some of his tools today. Okay, so he'll be visiting us in January. I'm going to quickly run through the different special interest groups we have. We have an investment discussion group, meets at Holders Country Inn. That's on De Anza or Sunnyvale, Saratoga, whichever you prefer, across from the Home Depot and Cupertino. Technically, it's San Jose. The discussion group is just a very general group. People come in, ask questions on any subject, very simple, very complex, and we just walk around the room and answer them as best we can. Lynn heads that up. Lynn is our chapter president. The guy's walking around with the mic. We have a new group that just started up last month. It's headed up by Fred Smith, and he did the financial planning workshop series. They're recorded, they're on our website, you can go take a look at it. Fred's a retired financial planner, and so he does this, free of charge. This is his way to get back to the world, so to speak. And now he's got a discussion group that meets on the second Wednesday of every month, again at Holders, same place. And that happens to be this Wednesday. Okay, so if you're interested in that, same sort of format. Fred usually kicks it off, talks a little bit about some financial planning topic, and then we go to questions. The last group is my computerized investing group. We just got done with our meeting on Thursday. We meet on the first Thursday of every month, again at Boulders. We tend to look a lot at algorithms and whatnot in terms of how you should invest, okay? But it's pretty wide. We will look at virtually anything in that regards. So it's been running about 5 years and very interesting group. A couple of things on social media just to make sure everybody knows about it. We do have a Facebook page. We post to it virtually daily. We try to put interesting articles up there, not necessarily just for AAII. We put things in there about our events. We put videos from universities and a variety of other sources, articles, podcasts, etc. Try to make it a little bit interesting. So just stop by and take a look, see what you can. The other thing we do is we have a meetup page. That is where you can figure out what's happening with every event and all our special interest groups. And you can have a conversation in terms of ask questions about whatever. So right now, for example, we have a meetup for this event. We've got a meetup for what's happening with Fred's FPW this week. So that's a good place to know, well, where are all the meetups happening. Eventbrite. Okay, we always get 1 or 2 people that have a question, and this is usually from the registration desk where they thought they ordered a ticket at Eventbrite. Got to worry about 2 things at Eventbrite. Number 1, you've only got about 8 minutes to actually go through and fill everything out. Okay? If you run out of time, you may think you ordered a ticket, but you really didn't. The second thing is, after you fill in all the information, you actually have to hit the pay now button. All right? So, I know that sounds simple, but every once in a while, we get somebody that says, yeah, I thought I did that, and it didn't happen, right? If you've ordered a ticket, you will get a confirmation email, okay? So if you don't get a confirmation email, you didn't order a ticket, just FYI. The most important slide and announcement. We're always looking for new people to join the board to help us out. We are running a lot of, we're actually kind of short-handed with only 6 people today from the board here. We got a lot of special interest groups that are happening, etc. So if anybody is interested in helping out in one way or another, find a board member, and we'll be more than happy to suck down all the time you have available. No problem. All right, general announcements before I get into the introduction. Number 1, turn off your cell phones, etc. No beeping. There is a wireless guest network available. I think it's called something like Guest.
George Lee to raise his hand. George Lee, raise your hand.
I have a request for George Lee to raise his hand. He's back there, Valerie.
Where are you? There you are.
So we are webcasting and recording this session. So if you're wondering what I'm doing down here and why there's all these funny wires and so on, that's what's going on. There's a couple of people down in San Diego, from the San Diego chapter, that volunteered to get up early in the morning, just watch this to see whether it worked. We have a very complex AV system, known as an area microphone on top of the pedestal here. So be aware. We are talking about inside the chapter about getting remote speakers to come in via web and so on. So that's why we're doing all this, to just give you a heads up. Consequently, we got a number of people that will have microphones of one type or another. If when you have a question, if you could wait for somebody to run on over to you and hand you a microphone, we'd appreciate it. Let's see, we do have a plan to have a break at 10:15. We're going to have a raffle drawing, and our speakers were kind enough to include a book in the raffle drawing. So for those of you who haven't seen it, they have a new book out. There's some examples on the table. There is water available. I think I talked about the restrooms. I talked about Forever Ticket. Fill out your survey forms. I unfortunately am the guy that actually has to go through and tabulate the survey forms. So this is sort of like me shooting myself in the foot here. Please give me more work. But it's a good work. We actually do pay a lot of attention to it. We have the concierge table up there. If you haven't gotten a packet with a survey form, they're up there, along with a bunch of literature and past handouts from past events. Yes, sir.
Where do we leave the survey form? Where do we leave the survey form?
On the way out, we'll have, you can just leave it on the table. There's usually somebody there calling out, survey forms, survey form. So, let's see. And one of the things we have to do with this location is basically clean up afterwards. So do what you can to just take your trash and throw it in the trash can and so on. Help us out. Thank you. Okay, so enough of my standing up here that way. So this is sort of a fun thing for me because a little bit of history about how Adam and Rodrigo ended up here. So 5 years ago, when I started the local computerized investing group that looked at algorithms and such, one of the first, if not the first algorithm we looked at was adaptive asset allocation by these guys. Okay, so I've been following these guys as they move from, I think originally Macquarie over to their own firm for about 5 years. Okay, so when HQ in Chicago basically sent out an email that said, hey, these guys are available and interested in talking to a group, I jumped up and said, yeah, me. Okay. And I think this is the first AA group that Adam and Rodrigo are actually presenting to. Okay. So there's a bit of history here, if you will. So Adam is Chief Investment Officer at Resolve. That's their firm. And I'm sure Adam and Rodrigo will go into that. 10 years of experience in investment management, 7 years as portfolio manager. Excuse me. He's primarily responsible for the research efforts. Rodrigo is co-founder and managing partner at Resolve. He has 11 years of experience. Adam, Rodrigo, and Michael, their third partner, co-authored the book that we have on the table over there. We'll be wrapping a copy off. So after they worked together, I think, if I remember right, Macquarie, the three of them headed out. They're actually located in Toronto, okay? But I understand they have U.S. and international accounts. Another little tidbit, way back when, 5 years ago when I read their stuff, I actually tried to say, hey, I'm interested enough to have them manage my money, but the firm they were working on at the time said, well, you got to set up a Canadian account, blah, blah, blah. They don't manage U.S. money. Okay, so, but that restriction is now off the table. Okay, so that's very good. So with that, I'm going to switch things over to Adam, and we'll take it from there.
So I'll just put this on there. Is this gonna work?
Should work.
Thanks for that. go ahead and test it, make sure it's not on. Testing. Turn it on a bit. Testing. 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 Testing.
Yeah, there we go. Okay, I think you may have to do
1,
something.
2, 3. 1, 2, 3. 1, 2, 3.
Whoop, wrong place. I think we're in business at this point. Let me know if you need anything.
We good? Hello, 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 hello. Hello, hello, hello. Hello.
More
hello.
volume.
Hello, hello. You're turned on, right? Yeah. How we doing?
Nope.
Not quite yet? While we're getting this, that sounds good. While we're getting this all straightened out, I just wanted to say that I'm very excited to be here speaking to you. This is our very first presentation to AAII chapter, and I am far more used to delivering these presentations to advisors. This is really the first presentation that I've delivered, or that Rodrigo and I have delivered to individual investors in 3 or 4 years. So we're very excited to do that. Candidly, we're out speaking to individual investors because, especially in the US, because we have this, what is essentially an active robo-advisor that we launched about a year ago. And so we can actually help to manage individual money now. Until we launched the online advisor, we were only really able to just distribute our solutions through advisors. So we're very, very pleased to finally be able to work directly with investors.
Doesn't seem to be working. Take it off. Maybe take it off is much better.
Can you hear me okay if I take it off and just speak naturally?
Much better.
Yeah? Okay. Well, we'll try that for now and
If
see.
you want, we can use this, and this actually works too.
Okay. We can try this one. If this is a little better, I don't know. Okay, sure, I'll try this one. I like to start off the presentations with a story because our minds really don't warm up to content unless we have some sort of narrative to frame it. I want to tell a story about risk because, you know, investment really at root is about managing and harnessing risk. And it's a very interesting story. It's derived from the book Command and Control. I don't know if anyone here might have read it, but it's a history of nuclear proliferation and nuclear strategy. And so I want to tell a story about a B-52 bomber. On January 23rd, 1961, this B-52 bomber left Seymour Johnson Air Force Base near Greensboro, North Carolina, to fly a patrol run down the eastern seaboard. And about halfway through their second lap, about 10 hours into the flight, they stopped to refuel in the air. They rendezvoused with a refueling tanker and began the refueling process. About 2 minutes into the refueling, a person working the refueling boom noticed that the plane, the bomber, was leaking fuel. And in fact, over the next couple of minutes, the bomber lost about 40,000 gallons of fuel out of its right wing. When they radioed in, command at the Air Force Base instructed the pilot, Walter S. Tulloch, Major Walter S. Tulloch, to dump the rest of the fuel for the plane into the ocean and prepare for an emergency landing. So Major Tulloch tried to dump the fuel, but the switches weren't working to dump the fuel. He wasn't able to do it, and it left the plane dangerously off balance. And about 12:30 in the morning on the 24th, the plane went into an uncontrolled spin, and blew apart in the air at 10,000 feet. Major Tulloch and 3 other crew members managed to successfully eject from the plane. They went on to live. One of the crew members, by the name of Adam Maddox, actually executed a jump from the evacuation hatch while the plane was upside down. He was the only airman in the history of the Air Force to successfully complete that maneuver. And so by this point, you may be wondering what this has to do with investing. So let me tell you, this particular B-52 bomber was carrying 2 Mark 39 thermonuclear bombs. And each bomb had a payload of about 4 million tons of TNT. Now, to put that in perspective, that's about 200 times stronger than the bombs that they dropped over Nagasaki and Hiroshima that ended World War II. And so as this plane went into its uncontrolled spin and blew apart, the arming wires were pulled. And so the bomb reacted as though it had been deployed in a tactical strike. And the pulse generator activated, which fired up the low energy thermal batteries. The parachute opened. At about 800 feet, their barometric switches fired, which armed the high voltage thermal batteries. And when the bomb struck the ground, the piezoelectric crystals in the nose were crushed, and this triggered the mechanism to fire the bomb. But the bomb didn't explode. Every single safety mechanism that was put in place to manage the risk of this nuclear explosion failed, except one. The safety switch in the cockpit. When the pilot had entered the cockpit, he'd flick that switch to safety mode. If it had been in armed mode, then a 4 megaton thermonuclear weapon would have detonated over a cotton field near Faro, North Carolina. Now, it's not inconceivable, given when this happened, near the peak of the Cold War, that a random nuclear explosion on U.S. soil in the eastern seaboard might have triggered a retaliatory strike by U.S. Naval Command and triggered a global nuclear holocaust, wiping out all of humankind. And so this is a story of risk, but it's also a story of uncertainty, because of course the Air Force had an enormous amount of protocols in place to manage this type of risk, but it's the type of risk that you can't quantify, you can't conceive of in advance. That is what eventually gets you into trouble. It's what Donald Rumsfeld called the unknown unknowns that get us into trouble. And so in this discussion, I want to talk about how to more effectively manage these unknown unknowns within your portfolio, because these are the ones that have the greatest potential to derail whatever your financial objectives are. There's a picture of the bomb in the ground in the cotton field. So what is risk in the context of investing? What is uncertainty? Well, I just wanted to illustrate the point that what we have realized in terms of the actual historical returns for portfolios is just one of almost an infinite variety of possible paths that returns could have taken to arrive at approximately the same place. What I'm showing here is what I call the cone of possibilities. And this is just randomly taking all these monthly returns for a US 60-40 balance portfolio and performing what is essentially a Monte Carlo or a randomization process to illustrate a wide variety, 10,000 other potential paths that stocks could have taken over the past 40, 50 years without violating the character of their long-term average returns. All of these returns are within the realm of possibility. Any one of them was certainly possible. And so, as we'll discover later, some of these types of paths would have been much more challenging for investors to navigate through. Anyone here read anything by Nassim Taleb? Black Swan, or yeah, a lot of hands go up. So you'll be familiar with the turkey analogy. For those who aren't familiar, Nassim Taleb invokes the metaphor of a turkey when he talks about uncertainty, and specifically the Thanksgiving turkey. So think about the life of a turkey. So a turkey is born on a farm, and from his very first awakening, the farmer cares for this turkey. He brings him grain to eat. At night, he puts him in a safe shelter to keep him safe from predators. Every single day, the farmer comes and feeds him. And as each day passes, the turkey becomes more and more trusting and confident about the farmer's intentions. And over the course of a year, each and every day, the turkey becomes less and less afraid of the farmer and more confident and trusting. Until a few days before Thanksgiving, when the farmer comes and chops off his head. Now that is a so-called black swan. That is uncertainty. That is the type of risk that the turkey could not possibly have anticipated in advance. How does this translate to the investment realm? Anyone here heard of the firm Long-Term Capital Management? A lot of hands go up. Now, this is the return trajectory. The blue line in this chart is the return trajectory for long-term capital management from inception until mid-1998. Now, you can forgive the investors in long-term capital management and the managers of long-term capital management for becoming more and more confident that their strategy was effective as each month and year passed, where the results mapped to what they expected. Until the fall of 1998, when Russia defaulted on its debts, when there was a massive devaluation of the Thai baht, and the extremely 13 times levered bets on international credit derivatives unwound against long-term capital management. And the fund had to be bailed out by the Federal Reserve, and investors walked away with essentially nothing. So that's one example of uncertainty. But we don't need to look so far into such an esoteric place. These are the returns to Japanese stocks, total returns to Japanese stocks from 1968 to 1989. Over this period, stocks averaged over 16% annualized returns over this 20-year period. You can imagine Japanese investors, in fact, the whole world. I mean, I don't know if you recall in the late 80s, the number of movies that came out depicting Japanese technology, and all the American and Canadian and world manufacturers were emulating Japanese manufacturing techniques, etc. At the time in 1989, when this chart is sort of ending on the right, the Emperor's Palace in Tokyo was valued, the land around the Emperor's Palace was valued higher than all of the land in California. That's a bubble. But you can imagine, right? The Japanese were at peak confidence toward the end of this run. Just in time for a 25-year period of negative returns. Right? Peak confidence, peak hubris, followed by a tragic outcome. And obviously over the last 26 years, Japanese equities have averaged less than almost negative 3% annualized and had a peak to trough loss over that period of minus 75%. So how do we think about the investment process? Well, first of all, we want to start with the end in mind. And to start, I want to completely redefine the purpose of investing. So we think the most important concept in investing is that risk is measured as the probability that you won't meet your financial objectives. It's not volatility, it's not drawdowns, and the importance of this definition of risk is that returns and risk are inextricably linked. Because most of us need a certain minimum amount of return in order to meet our long-term financial objectives. So we need to have a sufficient return, and at the same time, we need to realize that return with a level of risk that we can tolerate. And as a result, investing should have the exclusive objective of minimizing this risk. And so the approaches that we advocate and that we engineer and that we deploy are designed specifically to minimize the probability of failure. So this is one of the strategies that we've been running for a long time: adaptive asset allocation, diversified global investment strategy. These are simulated results. We do have a 5-year track record of live results. I show this because, I'm sure lots of people come up here and talk about great back tests. I've never seen a back test that I didn't like, right? It's always a winning year at Hindsight Capital. This is a live track record, and so the techniques that we're going to describe here today have been tested with real money, and the results that we observe are consistent with what we observed in simulation. All right, so obviously we're kind of taking a different approach than many investors take. For example, we don't do any stock picking whatsoever. We focus exclusively on global asset allocation. Why would investors consider doing something differently when the old traditional methods seem to have paid off so well over the last 25 or 30 years? Well, you probably heard people come in here and talk a little bit about this, so I'm not going to belabor the point. But on any measure that has demonstrable forecast value for both equities and bonds, U.S. equities and bonds are both pretty expensive. And expensive stocks, it doesn't mean that a crash is right around the corner, but it does mean that over the next 5, 10, 15 years, that we should lower our expectations about what these asset classes should deliver. This, just to give you an example, this is over 200 years of fixed income returns, going back to fixed income yields, 10-year treasury yields going back to 1790. You see we're pretty close to, if not at, the lowest historical yield over the last 200 years, around 2.35%. And unfortunately, this implies about a 0% annual expected real return for fixed income over about the next 10 years. It's some really well-documented research on how to forecast bond returns, but it boils down to the best estimate of bond returns is equal to the current yield, and the best forecast horizon is equal to twice the duration of the bond. So currently, 10-year treasury bonds have a duration of about 5 years. So double that, you're at 10 years. So over the next 10 years, you should expect about 2.5% annualized nominal on U.S. Treasury bonds, or about 0 after inflation. Okay? What about stocks? Well, stocks are always more contentious and more difficult to forecast. Anyone here familiar with the cyclically adjusted PE ratio or the Shiller K? Yeah, it's pretty common. pretty common valuation method. Basically, you take the long-term average valuation of the S&P relative to its smoothed earnings smoothed over the past 10 years, and adjust it for inflation. And you smooth it because earnings have a lot of volatility over the business cycle. Obviously, earnings drop during recessions and they rise during expansions. So you smooth it to smooth away those effects. And this model actually has a fairly high level of predictability for long-term returns. Now, some people have argued, and I think there's merit to these arguments, that the valuation of markets, of equity markets, should rise gradually over time. The average level of valuation should rise gradually over time because accounting information is a lot more regulated. Information travels a lot more quickly. Markets are a lot more efficient. And also just the observation of the long-term performance of markets gives investors a higher confidence about the potential range of outcomes. And so we should probably expect the average level of valuation to climb through time. So what we did is we said, well, maybe the long-term average is not the right way to value US equities. Maybe we should instead model the actual trend because valuations have actually gradually risen over time. This goes back to 1880. And so we modeled the rate of change of those valuations, modeled the rise, and we examined where valuations are today relative to that higher level of expected valuations. And what we observe is that markets are still about 40 or 50% overvalued, right? And just some really simple math, take 50% overvalued, and let's say we go back to average values over 10 years, well, you can knock about 5% a year off your expected returns, right? Some just really simple math. And it's not going to happen at exactly 10 years. Maybe it'll be 3 years, or maybe it'll be 15 years. I don't know. But the point is that expected returns should be lower. And in fact, we are at about the 7th percentile value in terms of expected returns over history based on this model and a combination of a few other models that actually bring the numbers up a bit.
Adam?
Yeah.
I didn't understand what you just said. Knock 5% off your expected return. Is that what you meant, or did you mean expect minus 5% return?
Oh, no, I'm sorry. Yeah, knock 5% off the long-term average returns. So the long-term average returns are 8. Compound annual returns are 8. Knock 5 off, and you should expect around 3, right? 3 or 4. That make more sense? Perfect. And so if we expect sort of 3 or 4% from stocks, and then you've got to knock off inflation, and then you've got after inflation expected returns for bonds of 0, right? This is now the expected returns for both stocks and bonds. When you combine them in a 60-40 portfolio, well, your expected returns on a 60-40 portfolio have only been worse than they are right now about 3% of the time over the past 130 years. And those times were in 1929 and in 2000. Right? So again, I'm not calling for a crash. I'm just saying we need to think differently about how we're going to generate the expected returns that we need in order for planning purposes over the next little while. And it actually is a little worse than this. Because the sequence with which those returns come has a tremendous impact on the outcome, especially for people that are in retirement, that are withdrawing funds. I'm going to give you an anecdotal example of this rather than going through a bunch of Monte Carlo stuff. Let's see if this is going to work for me here. Yeah. This is a case study of the Dow Jones total return, and we're just going to use the period from 1966 to 1997 because the math happens to line up really well. So over this period, the Dow averaged 8% annualized returns. So about its long-term average. And so somebody that was planning for their retirement in 1966 and were budgeting on a 5% withdrawal rate, when they model it out and an expected 8% return, where that 8% return comes every single year, 8%, 8%, 8%, because a lot of people still model retirement plans like that. Well, they would have modeled that dark blue trajectory where the portfolio was depleted after 30 years. Okay? So you're withdrawing 5% a year after inflation. You're expecting 8% a year every single year. That is the portfolio outcome that you would have modeled. But the actual sequence of the returns resulted in, after 30 years, a person starting with $1 million having a $4 million surplus. So obviously a very attractive sequence of returns, the outcome much, much better than expected. But it turns out that 1966 to 1997 period is actually constructed of two very different periods. The period from 1966 to 1981 was a terrible period for stocks and bonds. This is the total return for stocks from 66 to 81. Pretty dismal, basically zero returns over that horizon. And then followed by one of the most gargantuan and persistent bull markets in recorded history from 1982 or 1981 to 1997, when it annualized to 16% a year, right? So 0% for half the period, 16% for the second half, 8% on average. Now, what if we simply reverse the ordering of those periods, right? So now the 1982 to 1997 period comes first, and then the 1966 to 1981 period comes second. Everyone follow me so far? All right, so exactly the same, 8% average returns. Consider the same retiree modeling up his retirement for 5% withdrawals every year at an 8% average expected return, starting with $1 million. The light blue line shows what happened in that case. Same returns, same average returns, and yet this investor depletes his funds not even halfway through his expected retirement horizon. 14 years in, all his funds are gone. Compared to the other person who just happened to have a much more fortunate sequence of returns. So the message being that it's not just about the average returns that you expect, it's also about managing the stability of how those returns come to you through time. So how do we think about this problem? First of all, like I mentioned, we focus exclusively on asset allocation. It turns out that about 65%, 2/3 of what happens to your portfolio from month to month and year to year is explained by your asset allocation, and about 1/3 is due to the actual securities you hold in a portfolio. And so we focus on the asset allocation problem rather than focusing on security selection. The other reason is that if you have a concentrated stock portfolio, then you're taking far more risk than you need to take, and you're not getting an appropriate level of compensation for it. And that's because markets are efficient enough such that they will only reward the type of risk that cannot be diversified away. Now, it turns out that stock risk can be quite effectively diversified away to a meaningful extent. And so that portion of risk that can be diversified away, if you're exclusively invested in stocks, you're taking on that risk without being compensated for it. So, okay, if that's true, how can we diversify that risk away? And this is really where the rubber meets the road here, okay? And I don't know, it's hard to see that chart from where you are, I bet. But this chart really breaks the global economic environment down by two different dynamics. One is growth. Growth impacts how assets behave. And inflation. Inflation impacts how assets behave. And so you can divide the universe of potential economic outcomes into 4 quadrants, divided along those 2 dimensions. So, for example, during periods of low inflation and high growth? Well, that's like the 1990s, right? We had fantastic growth in developed equity markets, right? The tech boom happened in that period. And what about periods of high growth and high inflation? Well, that's the knots, right? Sort of 1999 to 2007, emerging market boom, commodities, real estate, hard assets. Those do very, very well because they're designed to do well in that type of environment. Meanwhile, periods like the 1970s, where you had both low growth and high inflation, well, neither stocks nor bonds do very well in those periods. As we'll see, gold and commodities were what you needed to own in the 1970s in order to generate returns. And then, of course, there's periods like what we just saw with Japan from 1989 until today, and what we observed in the Great Depression, and for a period in 2008, period of very negative growth shocks combined with very low inflation. And the only thing that works are very long-term government bonds, cash, and sometimes gold, depending on how central banks behave. And so the way to diversify a portfolio is to own assets that are fundamentally engineered to thrive in very different economic scenarios. Stocks are only fundamentally designed to do well during periods of better than expected growth, abundant liquidity, and benign inflation. In any other type of economic environment, and we happen to have had that environment for much of the past 30 years. But as we'll see, that is actually atypical through history. I don't know if you can even read this shirt from there. I can't. It says there are two types of people in this world. One, those who can extrapolate from incomplete data. And in markets, this is where we are all the time. We have very incomplete data. We're always operating with a high level of ambiguity, a high level of uncertainty. The question is, how can we translate our uncertainty into the right type of portfolio? Well, if we have total uncertainty, if we have no informational edge whatsoever, then, I don't know if you can see this, you would hold a passive portfolio, a purely passive portfolio. Because this passive portfolio is taking advantage of the wisdom of all of the other market participants, right? Now, each individual market participant is operating with limited information. But when you aggregate all of their votes and get the market capitalization weighted portfolio, then a lot of that error gets averaged away and you're left with a meaningful signal. And there's a compelling argument for market cap weighted passive indexing. We'll talk about that. But sometimes there are other things that we can estimate with reasonable precision in markets that allow us to design portfolios that may be more resilient. And so we're also going to talk about that. And those things that we can know really boil down to three things, right? You need three different types of estimates to create a perfectly optimal portfolio. You need a measure of the volatility of the assets, the risk of the assets. You need a measure of the correlation between the assets. And you need some estimated returns. That's to make a perfectly optimal portfolio, mean variance optimal portfolio. But oftentimes it's really, really hard to estimate returns. And so the question is, are there optimal portfolios that we can form that make no assumptions, that require no estimates for returns? And we're going to go through some of those examples. And these examples actually assume that markets are reasonably efficient. Efficient how? Well, markets are efficient if investors are rewarded for taking risk. More specifically, if an investor is taking twice as much risk, then he should get about twice as much expected return. In other words, if all asset classes have approximately the same expected long-term return to risk ratio or Sharpe ratio. Now, empirically, we observe this. Over the very long term, stocks, bonds, commodities, etc., have about the same return per unit of risk. Stocks deliver, to keep the math simple, 10% a year at 20% volatility. Bonds deliver 5% a year at 2.5% volatility. Right? Or sorry, at 10% volatility. And so if those natural forces are at play, then actually you don't need to estimate returns. There are ways to engineer portfolios that simply express the view that over the long term, these major diversified asset classes should give you approximately the same return per unit of risk that you're taking. And these are the risk parity type portfolios that we're going to discuss. Does anybody have any questions so far? Yeah.
If you're suggesting that we should choose asset allocation based on the very long-term historical averages, that ignores the near-term perturbations that drive returns. So can you explain?
Yeah. So you know, as we go through this, I didn't ask him to ask this question, but we're gonna go through that specifically. Absolutely, yes. Thank you. I'll answer that in great detail. Before I do, though, I do want to talk about passive, because a lot of people think about passive investing as owning the S&P 500 or owning the Vanguard Total Market Portfolio, or maybe owning a passive 60/40 portfolio of Vanguard market cap weighted products. And I want to investigate that, because it turns out that a portfolio that's just contains market cap weighted US stocks and bonds actually allocates to less than half of global asset classes. So, in fact, a US 60/40 portfolio is taking an extreme active bet. It's an active bet against international assets and 100% for US assets. Now, there may be some among you that are doing this deliberately. Maybe you genuinely believe that there is some sort of long-term, persistent dimension that makes the US particularly attractive, so attractive that you completely ignore all of the other global opportunities. But don't mistake that view for the fact that you're expressing a passive portfolio. You're not. You're taking a very active view. You're an active investor in making those decisions. If you did want to be a genuine, true passive investor, there really is only one global portfolio that you can use to be a passive investor, and it's the global market cap weighted portfolio. And there was a really great paper that came out in 2012 that described the construction of this portfolio, constitution. There it is. It's mostly the largest global asset class is actually international bonds. Raise your hand if you own any sleeve of international bonds in your portfolios. Good, an enlightened group, because I usually don't see any. It's the largest global asset class, and yet most investors have zero or almost zero allocation to it, right? Now, on our website, we publish an ETF-based portfolio that actually mimics the global passive portfolio. If you genuinely want to call yourself a passive investor, that is the way to, that's the route to be able to do so. We're going to post these slides up, so you don't need to copy them. But also, those of you, anyone here a fan of traditional smart beta or factor investing, value, momentum, quality, all that kind of stuff? No, really? No? Okay. Yeah. For those of you who do believe in those, the fact that those factors may deliver slightly better performance over the long term, we also created a portfolio that includes allocations to momentum and value and quality and low volatility, et cetera, in ETF form, while maintaining the appropriate asset allocation that you would need to be a passive investor. So I would expect, for example, this portfolio to deliver slightly higher returns due to those factor exposures. Yes,
When are you rebalancing?
great question. So the actual global market portfolio shouldn't require any rebalancing because as securities are retired or issued, those get factored into the total market. In reality, that there are frictions there, so I would advocate rebalancing this every 2 or 3 years. Yes?
So on the global portfolio, you know, a variety of different companies and indexes and so on.
Yep.
All offer those sort of things. There seems to be inconsistencies between the different global market portfolios. Okay, and sometimes they're not all that large, but sometimes they are.
Yeah.
Okay.
Yeah.
And so, how do you explain that?
No, it's a good question. Really, the only major difference is that some global market portfolios include non-marketable securities. So, for example, they include private real estate holdings, residential real estate, buildings, these types of things. So the portfolio that I was showing is the liquid market portfolio. So those are of traded securities, right? But good question. There are some others say that the market portfolio, you should hedge currencies. Some don't. We say don't. Hedging is an active bet. Anyway, but they all sort of come at the problem from the same direction. All right.
Why is hedging an active bet? I would say hedging is a non-active.
Well, I mean, you're taking the active view that currency exposure is because if you did nothing, right, then you would have the currency exposure. Whereas you're taking the active view that you don't want that currency exposure in order to put on a bet. But if you wanted to actually own the true cap-weighted portfolio, then it would include those currency exposures, right? All right, I want to start a conversation about diversification because in my experience, many investors don't really get this right. And so really diversification is about a combination of two things. Number one, it's about diversity. And number two, it's about balance. So we're going to start with diversity. We talked about the target chart. But here's Peter Bernstein on diversification. In general, survival is the only road to riches. Let me say that again, survival is the only road to riches. That's what diversification is for. It's an explicit recognition of ignorance, right? Imperfect information. That's the best you can possibly hope for in markets. So remember I said that the current period is rather anomalous for a 60-40 portfolio. This chart goes all the way back to 1900, and it shows 4 periods of 10 or 15 years where a 60-40 portfolio of stocks and bonds delivered 0 or negative returns. 4 periods of 10 to 15 years where a 60-40 portfolio delivered 0 negative real returns after inflation. Obviously, the current period has been particularly flattering for a US 60-40 portfolio, but remember the turkey story. It always feels the most comfortable. We're always the most confident right before somebody chops off our head. So again, diversification starts with diversity. So we want to hold all of the world's major asset classes, get exposure to all of the regional growth engines in the world. Include things like treasury inflation protected securities, gold, diversified commodities, emerging market bonds and stocks. In fact, if you look at some of the capital market expectations, the forecast from, for example, BNY Mellon or JP Morgan, Goldman Sachs, all of these different groups, AQR, research affiliates, show that emerging market stocks, bonds, and currencies have by far the highest forward expected returns from here. So they should be included in portfolios, right? So this is our investment universe. Because sometimes stocks and bonds, they don't do well together. They struggle together. Remember I said in the 1970s, were a particularly bad period for both stocks and bonds. They delivered negative real returns over the period. But if you included gold and commodities, well, you had 800 to 1200% total returns in that decade in gold and commodities. Holding some gold and commodities would have largely offset the meager returns to stocks and bonds. Now this chart is a bit of an experiment. I took a risk that there's, can I get a show of hands of background in this room? Anyone here from the engineering field? Okay, perfect. Anyone here from the medical field? Okay, so that's like 95% of the group. So, okay. So hopefully you'll find this interesting. I found it really interesting. Volatility is about the magnitude of risk. Diversification is about the direction of risk. Now, think back all the way back to your high school vectors class. Grade 10 vectors, grade 10 trigonometry, right? We're going to add vectors together. The length of the vector is the volatility, the magnitude of risk. The direction of the vector is the direction of risk. So if you have two perfectly correlated assets, you hold 50% in asset A, 50% in asset B, they both have a volatility of 10%, and they're both perfectly correlated. Well, if they're perfectly correlated, it means that their risk is pointed in the exact same direction. So you can simply take 50% of asset A's risk, so 5%, 50% of asset B's risk, 5%, add them together, and the total portfolio risk is 10%. Make sense? Now what about two assets that are uncorrelated? Their risk goes in perpendicular directions, right? So here's the sum of those two. So now the uncorrelated portfolio, right? So now asset A goes left to right, asset B goes down to up, right? So they're going in completely different directions. Turns out that the magnitude of portfolio risk can be determined using the Pythagorean theorem, right? The square on the hypotenuse is equal to the sum of the squares of the other two sides. And so we can find the volatility of this portfolio by taking the squares of each side, so 0.5 times 10% squared plus 0.5 times 10% squared, and then taking the square root, and the length of the hypotenuse is 7.07, which is the volatility of the portfolio. And that is how volatility and correlation play into the reduction of the volatility of the portfolio. Did that make sense? Can I get a show of hands to see whether I want to include that in presentations in the future? Okay, all right, that's good. Rodrigo didn't think that was going to work, so I'm And I don't know if there are any sci-fi fans in the audience. I'm a big Arthur C. Clarke fan. And Arthur C. Clarke said, sufficiently advanced technology is indistinguishable from magic. I sort of paraphrase, sufficiently diversified portfolios are indistinguishable from magic. And this formula just generalizes the impact of correlation on portfolios. What it says really is that the more uncorrelated sources of return that you can include in the portfolio, the lower the overall portfolio volatility. Okay? That's that simple formula. And there are some implications, right? So portfolio volatility is inversely proportional to the number of uncorrelated bets. More bets, the better for lowering portfolio volatility. That volatility is directly proportional to the average correlation between the investments. In other words, volatility goes up as the different investments become more and more correlated to one another. It also means that diversification has diminishing marginal return. Like it's a square root function, right? So you can't just keep adding assets and expect a linear reduction in risk. Eventually it becomes asymptotic and it's no longer useful. So let me unpack this chart because there's a lot going on here. for the engineers room, this is a parametric chart. All of the different colored lines assume a different average correlation between securities or between assets. Now I want to zero in on the dark blue line at the top. That dark blue line models the risk-adjusted return to a portfolio, assuming that it contains assets that have a correlation of 0.1. So almost perfectly uncorrelated assets, right? Now along the bottom of this chart, we are adding assets to the portfolio. So you see 1, 2, 3, 4, 5 assets. And on the y-axis, that shows the performance per unit of risk from the portfolio. Now, just to provide an example to anchor this, at the far left, with the far left orange, where it says 0.3, you probably can't see that from there. It says 0.3 there on the y-axis near the bottom. Well, 0.3 is the average excess return per unit of risk that you get from, for example, diversified equities or diversified bonds. The long-term Sharpe ratio is about 0.3. Now, because bonds and stocks on average are uncorrelated, they have a correlation of about 0.1. When you combine them together, you get 0.42 units of return per unit of risk. That's the two assets, right? So you move across there, just up the blue line, that's two assets, 50-50 stocks, bonds, in equal risk, okay? But you can see as you add more and more assets to the portfolio, then you're getting more and more bang in terms of excess return for your buck in terms of units of risk, right? So again, I just want to hammer home, the objective of investing should be defined as many uncorrelated sources of return as possible. But not all assets are created equal. Diversification requires balance too. Consider a 50-50 portfolio of stocks and 10-year treasuries. Well, it turns out that because stocks are so much more volatile than bonds, that 90% of what happens in that portfolio is going to be dominated by the stock side. It's 50-50 stocks, bonds, 90% of the returns are dominated by stocks, right? So if you have 5 days where stocks go up and bonds go down, well, you're going to have a rising portfolio and vice versa, right? How do we know this? Well, if you perform a simple regression of a portfolio of the returns from a portfolio that's 50% stocks and 50% bonds, you regress the returns from that portfolio on a stock portfolio, the stock portfolio explains 90% of the risk. It explains 90% of the returns. So essentially your 50-50 stock bond portfolio is a stock portfolio. Okay? And it's going to behave like a stock portfolio. And that's exactly what we see. This imbalance is revealed during periods of crisis. This is the turkey getting his head chopped off in 2008. That is a 50-50 stock bond portfolio. Down 25%. In order to balance stocks and bonds so that both stocks and bonds can express their unique properties, you've got to balance their risk. You've got to have about 80% of your portfolio in bonds and 20% of your portfolio in stocks. That's a risk balanced portfolio. How does that look in 2008? Risk balance. Bonds do very poorly in 2000, or bonds do very poorly during periods of inflation, but they do very, very well during periods of equity market crises, like we experienced in 2008. Great. So we need diversity, a wide variety of asset classes designed to do well in different economic environments. We need balance. Not all of those asset classes have the same risk. So we need to balance the risk across those asset classes with different risk characters. Let's combine those. Now, we needed the full screen versions of these, right? Consider the 13 assets in our global portfolio. There's 5 different bond assets and 8 different equity type assets, equities, REITs, commodities, gold, etc. So this actually is a pretty good proxy for a global balanced portfolio. Okay, 60-40 global balanced. But if you X-ray this portfolio with your risk goggles on, what we see is that the bond portion there on the left, those are the risk contributions, the risk, in terms of volatility that each of the asset classes is contributing. You can't see the exact numbers there, but you can see that the bars on the left are much, much smaller than the bars on the right. The bars on the left are the amount of volatility that's being contributed to that portfolio by bonds. The bars on the right is the volatility that's being contributed by stocks and commodities and other asset classes. So it's a completely equity, risky asset dominated portfolio. The bonds have no opportunity to express their diversification property. This portfolio, during a period of slow growth or declining inflation, is going to do very, very badly. In order to effectively balance off the fact that these assets have very different risk profiles, you need to hold a lot more of the capital in bonds and a lot less of the capital in stocks and REITs and commodity type assets. This portfolio that you see here, the weights in this portfolio, make sure that all of the different asset classes are expressing the same amount of risk and the same amount of expected return in the portfolio over the long term. This is a global risk parity portfolio that was formed from taking the long-term average correlations and volatility between all these asset classes from 1991 to today. Okay? And you can see that when you hold these assets in perfect balance, that now all of the assets are contributing the exact same amount of portfolio volatility. You have maximized diversification. How does this look? Well, going back to 1970, this portfolio, this risk balance portfolio in light blue versus the global 60-40 portfolio in dark blue. Well, the light blue risk parity portfolio delivered about 8.5% returns, about the same as risk parity, but it did so with far less risk. So for example, the global balance portfolio had a volatility of 10%, 9.87, whereas the global risk parity portfolio had a volatility of 6.5%. The maximum peak to trough loss for the balance portfolio was 30% in 2008. It was 20% for the global risk parity portfolio. And again, sequence of returns, we want to have more stable returns. Well, we had positive returns in 80% of rolling 12-month periods for the balance portfolio, for the global balance portfolio. The risk parity portfolio, 88% of months delivered positive performance. Yes? Hands are going up. Let's see it.
If you were to take the ratio of those two curves, the relative strength, you would see 20 years from 80 to, if you were to calculate the relative strength of the risk parity portfolio, you'd see 20 years from 1980 to 2000, in which the risk parity portfolio provided substantially lower. Could you comment? I mean, I don't like the fact that you're looking at two endpoints on a 40-year graph.
Oh, don't worry. I engineered those endpoints so that they had the exact same return.
No, you didn't. But anyway.
I did. I engineered them so that they had the exact same return. Because you
the
can.
range of data you had. That's not.
What's that?
That's the range of data you had. You used everything. That's.
No, I did. But I also scaled the returns to both portfolios so that they have the same returns. So that.
Okay. Well, could you please comment?
But I will absolutely,
on
yeah.
the fact that there were extended periods of substantial underperformance in the risk parity portfolio.
Absolutely, yeah. So the risk parity portfolio is designed for investors who believe that they can't forecast the future. If you can forecast the future, you should use some other techniques that allow you to express your expected return bets. If you knew in 1982 that stocks were going to deliver much better returns, well, I mean, keep in mind from 1982 to 2007, long-term treasury bonds actually outperformed equities. But if you knew that stocks were going to do really, really well, then of course you'd absolutely want to tilt your portfolio to stocks. what the risk parity portfolio is for is very explicitly expressing the view that you don't know the future. And so, yeah, absolutely, the risk parity portfolio is going to underperform whatever the dominant asset class is in any given period. When you're diversified, you always have something that you hate in the portfolio. That's the point of being diversified, right? And so, you're going to have these long periods. Even the current period is another example, right? You see it's kind of flattened off the past 3-4 years. Well, U.S. equities have completely dominated. Now, if you look around the world, until 2017, ex-U.S. equities, ex-U.S. bonds had delivered flat or negative returns for the previous 1, 3, 6, and 9 years. So yeah, of course, a concentrated allocation to U.S. equities would have completely dominated. But you can't, if you can't know that in advance, the risk parity is a logical alternative. Does that answer your question? There's other hands going up. Yeah.
So if you can engineer the endpoint, that means you can engineer the average for the compounded return to be a higher number.
Yeah, absolutely.
So what limits you from making that number bigger and bigger?
Well, no, I mean, it's just scaling it with risk, right? You're saying I'm going to take on a little bit of leverage to hit the same return as the stock portfolio, or I'm going to reduce the exposure to the stock portfolio so that it has the same return as the risk parity portfolio. It's just a matter of scaling it, and I'm going to cover all this in detail a little later and how that works. But
so there is no limit. As long as you're willing to leverage up and leverage up more.
Well, there's a theoretical limit,
That's what I'm asking.
mathematically, but it's actually the limit is very, you don't have to go very far towards that limit to achieve very attractive returns and much better risk profile than you get from a more traditional portfolio. So as we'll show you, sort of 40%, 65% leverage gets you really far in terms of getting towards stock returns, but with much, much less risk, right? Yeah?
Yeah, I guess the way that you balance your asset allocation globally, you're going to have to look in each market, what is the situation with respect to growth and inflation? And that's pretty different, say, in Japan versus Southeast Asia versus Europe, whatever. So then I guess you have to say, well, I'm going to guess that in the next 3 or 4 years, in this part of the world, I'm going to be there, and therefore, for assets that belong in that part of the world, I'm going to organize them that way. And then you throw that in the mix. Is that what you're doing?
Yes, I probably should have said this right at the beginning. This probably could be a source of some confusion. We're quants, so we're completely mathematical investors. So the way we formed this portfolio was by taking the long-term average volatility and correlation between, we have long-term data, just daily data for all these assets. So we can find their long-term volatility and their long-term correlation, and then we can engineer the portfolio, the constitution of the portfolio, so that it is effectively balanced over the long term. Now, I think I take your point, which is the same as the other gentleman's point, which is growth and inflation dynamics change through time and in different parts of the world. And so I absolutely agree we should be managing that portfolio more dynamically. And the whole next part of the presentation is going to be addressing that specific point.
And now a second question, I'm sorry.
Yeah.
If you try to guess what's happening in Europe, you say 3 years ago, with respect to what's happening now, right? Good luck, because things are really not gone the way people thought they would.
For sure.
So do your models have a way to accommodate that kind of risk, the risk of guessing wrong of what the environment is?
Well, that's really that's the secret behind risk parity, is that if you're wrong, then there's some other assets in the portfolio that are there to do well, right? There's always going to be an asset that's killing it, and there's always going to be an asset that's killing you. And they'll offset each other. And then right in the middle is the bulk of assets that are chugging along, doing what they normally do over the And so you don't need to guess about what's going to happen in Europe or what have you. That is really the crux of what I'm trying to get across. So thank you for helping me with that. Yeah.
I've heard that the U.S. market is like safe, the government is stable, but I've heard the world market is not so safe. Like what if there's a war or a Greece debt problem? I mean, how do you account for global risk of that nature?
Yeah, that's a good question, and it's uncomfortable. I mean, there's a reason why. By the way, people from every country in the world, every developed country, feel the same way about their own country, right? Canadians, for example, have 62% of their assets in Canadian stocks and 80% of their fixed income in Canadian bonds. Canada represents 3% of global markets. So, they're 20 times overrepresented. We see the same thing in the UK, the same thing in Australia. That's a very normal way to feel. I would just say that when there's the potential for these types of political disruptions or economic disruptions, that actually is typically played out in the price action. So the volatility of that asset category begins to go up. It becomes to be more correlated with riskier assets. Riskier assets in general become more correlated to one another. And the combination of a pickup in volatility and a rise in correlations between certain types of assets will serve to lower the allocation to those risky assets in the portfolio naturally, right? But that requires a more dynamic process, and that's what we're going to discuss in the next section. Yes.
So you mentioned something that I found interesting in terms of the light blue line here, the risk parity line. For investors who don't believe that they can predict the future, okay, and I'm thinking index investors, passive investors, should they just adopt risk parity on the global market portfolio, okay, and say that's the best I can do? And because there's a number of people in here, I'm sure, who, hey, I'm an index investor.
Right.
Okay. So is that a reasonable approach for someone who believes in passive approach to investing and say, hey, all this alpha and factor investing and so on, that's all really nice. Okay, but
it's not for me. Yeah.
It's not for me, or it doesn't work.
Yeah. I think you could do a lot worse. I mean, that's essentially what this is, a long-term risk parity allocation to the global market portfolio assets. And I mean, the evidence is strong, but I would just really like the theoretical framework. All you're really saying is that return is commensurate with the risk that you take. That is the assumption that you're making here, that return is commensurate with risk, and that you can estimate with some degree of precision the correlation and volatility profile of these major global asset categories. And the great thing about the way this optimization works, called equal risk contribution, is that you can actually get the estimates pretty wrong without materially changing the constitution of the portfolio, which stands in very stark contrast to typical portfolio optimizations, where even small changes to the estimates can result in completely different portfolio constitutions. Yeah.
No matter how you select your weights, the core, it seems, of however you design the portfolio requires you to do two things. One is select a finite number of assets from which you're going to pick the weights. And two is compute the historical correlations between them. Now, one of the problems is, which I've looked at in minute, horrible detail, is that the correlations between any two assets these days is exceptionally high. It's unbelievably difficult to find an actual portfolio of securities which have a correlation of less than 20%. I mean, if you just pick any random portfolios of 10 stocks or any other things, ETFs, whatever you want, you'll find that 50% or more of the cross correlations are way higher than 20%. In which case, what does uncorrelated mean? And by the way, I mean by correlation the Pearson coefficient. And I wrote a program that does this all over the place. You can pick 45-day intervals, 90-day intervals, year intervals, more than a year, you get the same effect. So these are highly non-stationary processes.
Yep.
So on what rate of change are you changing their weights given this fantastic churning of correlation? Because you can't just ignore the very thing you're focusing on, which is time varying correlation.
Absolutely.
Okay, end of my speech.
Yeah, no, that's great. I'm completely agree. And the next portion of the presentation is going to focus exactly on that problem. And we can talk at length about it later too. We've done a lot of work on it. Yes?
You mentioned that people tend to invest in their own country. Well, their common wisdom is that you should invest in what you know. Yeah, you typically don't know much about, some like Indonesia or Thailand or something like that. I know practically nothing about it. So why should I invest in a country or in stock or a bond in some area that I have no clue of what's going on?
Yeah, I mean, I empathize. I think the reality is that people don't realize that so many other dimensions of their life are connected to where you live. So in terms of a broader definition of diversification, think about if your home country goes into economic stagnation, for example. What does that mean to your income? What does it mean to your pensions? What does it mean to your home prices? Right? You can't really diversify that risk away by holding all of your assets in your domestic country, right? The whole idea of invest in what you know, I take great exception to, because the things that you know are the things that you're most tied to. It's like people who work at a company and hold all their assets in their company's stock. That's an extreme example. Now, I'd say this is Silicon Valley. I suspect a large number of the people here have made a lot of money by keeping all their money. And in fact, if you want to get rich, that is the way. It's through concentrated, very large bets on things that you directly control. But if you want to stay rich and diversify against the type of really awful Turkey-style uncertainty, then there's a really strong argument, I think, for straying outside of what you know. But I agree that you need to do so thoughtfully and with a theoretically and empirically robust methodology. Just any other questions? Okay, I think we plan to have a break around now, right? So I will break for, what, 10 or 15 minutes?
10 minutes.
Okay, 10 minutes, great, yeah.
So if you can find a seat. Now, does everybody have their red raffle ticket? Falling on the floor. Okay, we're going to draw some numbers. We're going to have actually one drawing, and then our presenters are going to do a secondary one, and I'll let them explain how they're going to do it. So we're actually going to have 4 chances today to get something. So the first of them is a draw for an investment book, which includes one of our presenters' asset allocation texts. And whoever gets this can pick any of these books over here, and it's yours. So I'm going to ask, Adam, you want to put one?
Sure.
Thank you. Just read the last 4 numbers.
0696.
0696.
Any bingo?
Okay. Anybody?
0696. Don't tell me we lost someone through my presentation.
0696. Okay, I guess we'll draw another number.
Must be present to win.
Must be present to win.
All right. 0729. Bingo, there we go, great.
Okay, just go over there and pick the investment district one out. Now, Adam you're gonna do the rest of them.
Yeah, so I thought it would be, I guess, a little bit fun to ask a few questions. And whoever gets closest to the answer wins the book. Hopefully, you'll think that's reasonably fun. So my first question is, in 2008, there was one asset class of extremely large, well-known asset class, long only, nothing fancy, that did very, very well during the financial crisis. Who can answer which one? Gold. Not gold. That's a common one. That's a good one.
Treasuries?
Treasury bonds. Absolutely. Here you go. Treasury bonds. My pleasure. And I guess you can't answer this because you already got a book, but does anybody know what return treasury bonds generated? Long-term treasury bonds generated in 2008? 16. Close. Anyone else? Anything else?
617.
17, okay.
6.
Someone's a game theorist.
6.
6, okay. Long-term treasuries now, okay. Any other guesses?
12.
No.
7.
17 wins it because it was 30. 33%, thank you. 33%.
Was that 10-year bonds or 20-year bonds?
The long-term treasury bond. Yeah. There you go. Hopefully you can share it. I think you gave that. And what was the third one?
Can somebody tell us the Pythagoras theorem?
Oh, yeah. Who's going to be the first one to tell me the Pythagorean theorem? Let's hear it.
A squared equals B squared plus C squared.
Okay, perfect. Got it. Yep, I like it. All right. It's true. That was a review question. That's good. Did anybody get everyone ready for us to continue, or? Take the microphone. All right, I'm going to do about the first half of this section, and then Rodrigo's going to do the back half, so my voice doesn't go completely. So the first section was really to hammer home the idea that you should start to contemplate diversifying your portfolio outside of more traditional domestically oriented stocks and bonds, because domestically oriented stocks and bonds are currently pretty expensive and forecasting pretty low returns over the next 10 or 15 years, the type of returns that may not support many of your financial objectives. And then we walk through the real definition of diversification as a combination of diversity plus balance, and how diversity means owning a diverse range of assets that are fundamentally designed to do well in very different types of economic environments. And that because of the different risk character between, for example, stocks and bonds, that you've got to make sure to hold those assets in balance. In a particularly attractive way to do that is by applying this idea of risk parity, where you hold a larger allocation to lower risk assets with low correlation to the other assets in the portfolio, and a smaller allocation to riskier assets with a higher correlation to other assets in the portfolio. But we had, I'm going to say, 5 or 6 questions from people who made the case that using these long-term averages are maybe not consistent with the fact that markets do change, and sometimes rather profoundly through time. And so just as an example of what you were saying, sir, I can't read your name, sorry. Lloyd, about the non-stationary nature of these variables, volatility and correlation, these two charts show the rolling observed volatility for stocks and bonds at the top, and correlation between stocks and bonds at the bottom. You can see, for example, that stocks range from a volatility of about 4 or 5%, like we're currently observing, all the way up into the 40 and 50% range, like we observed in 2008. And bonds, in their own way, have an equally large distribution of potential volatility. And the correlation between stocks and bonds ranges, on average, between about minus 0.5 and plus 0.5, and portfolios behave very, very differently when the two assets have a correlation of 0.5 than they do when they have a correlation of minus 0.5. And so I don't think it's enough to just use the long-term average estimates for correlations, volatility, or returns, because it's like the joke about the economist who says, I've got my head in the oven and my feet in the freezer, so I feel just right. And so what we're going to talk about now is a way to adapt portfolios through time in explicit recognition of the fact that markets change and evolve. So think about a typical experience for somebody who practices a strategic asset allocation. Right? So again, our ubiquitous 60-40 stock bond portfolio. You can see this is calendar 2008. And so you can see that, and the orange bars on the chart show the long-term average 95% range of those daily up and down moves, right? So the light blue line are the daily up and down moves for this balanced portfolio through 2008. And the orange lines show where those returns have been on average 95% of the time through history, right? And so you've got this static portfolio, and as the quarters go on, you continue to hold this same 60-40 portfolio of stocks. Maybe it changes a little bit because you're getting higher returns on stocks and bonds or vice versa. But on average, around 60-40. And then you approach the back quarter of, or back third of 2008, and all of a sudden, every single day, the returns on your portfolio are massively outside of the range of what you signed up for when you signed up for this long-term strategic 60-40 portfolio, right? So you're holding your allocations constant and letting risk happen. The dynamic asset allocation techniques that we're going to cover now are about targeting risk and letting the asset allocation change through time in response to changes in measures of volatility and correlation. And as we go on, there'll be other factors that we'll include. So you can see a portfolio that is, for example, like we're trying to keep the portfolio in balance, maintain risk parity by observing the current correlations and the current volatilities through time, and changing the constitution of the portfolio to maintain the maximum amount of diversification or balance. And then also, once we've maximized the diversification in the portfolio, well, let's say we're trying to target a specific risk. You signed up for a specific risk. You wanted a balanced portfolio. The long-term average volatility of a balanced portfolio is 8 to 10%. You signed up for 8 to 10% market volatility. Well, when we create our maximally diversified portfolio, maybe in 2008, the volatility of that portfolio is 15% when it's fully invested. So we need to take 1/3 of the assets out of that portfolio and hold cash to get back to our 10% target volatility. So you can see you can maintain your target risk profile by observing the current risk of the portfolio and scaling exposure to this portfolio vis-a-vis cash, and as we'll see, leverage when the volatility is very low to achieve your target volatility. The dark blue line there is our managed volatility dynamic risk parity strategy at the same target volatility as a balanced portfolio. And you can see if we hadn't overlaid the light blue line behind it, you wouldn't even be able to notice that there was a change in the volatility character of the market by observing the dark blue managed volatility strategy line, right? So, yeah.
So in your modeling, what's the impact of capital gains tax or what's the impact of capital gains tax or having in your equity portfolio some potentially substantial amount of unrealized capital gain?
Yeah, well, I mean, unrealized capital gain in your equity portfolio. Obviously, I'm not an accountant. I'm not going to comment specifically on tax implications other than to say that these strategies are higher turnover and you do crystallize short-term capital gains. So they are particularly well suited to retirement plan type assets and to endowments and pensions and this sort of thing. But in fact, the after-tax profile of the strategy, because it is so stable and because you are minimizing the sequence of return risk, is still quite flattering relative to a traditional portfolio. A good point, though. Absolutely, yes. And so just expanding our example to the 13 assets in our global investment universe and measuring volatility and correlation on an ongoing basis in order to constantly reconstitute the portfolio so that the assets are in risk parity and that we're targeting our target volatility. Well, that is how the portfolio changes through time. Each of those colors represents the weight of one of the assets in the portfolio. So you can see that the portfolio constitution does change fairly actively through time. You might be able to see the white spaces in there that are around 2008. Right in here, that's a big white space, for example. So that is where we have maximized the diversification of the portfolio, but the portfolio is still too volatile. And so we needed to put cash in a portfolio in order to continue to meet our expected volatility targets. Does anybody have any questions? Yes?
Yeah, how often are you rebalancing it?
In this case, it's monthly. Yep. Some of our strategies rebalance more actively than that, but in this case, it's monthly. And this is really going to irritate Peter. I'm sorry, but here's the long-term dynamically rebalanced risk parity strategy going back to 1970. You can see again that you really aren't able to recognize those recession or market crisis periods that you can very clearly identify in a typical sort of balanced portfolio chart. You've just got assets in there that are able to do really, really well during the inflationary 1970s. Other assets that are able to do very, very well during the disinflationary growth of the 1980s and 1990s that are able to do very, very well. Remember, treasuries up 33% in 2008, right? So there's just assets in a portfolio that are designed to do well in very different economic environments. This is just regular risk parity. Peter, avert your eyes. I'm really sorry. Here's another long-term chart. But again, just showing the same type of profile. We haven't scaled the returns here or anything. This is just the natural return profile. And you can see that the global 60-40 delivered 9.35%. The dynamic risk parity delivered 9.7%. And the risk parity strategy delivered the returns with about 40% less risk and less than half the drawdowns over the period. There will be long periods where the global risk parity will underperform a domestically oriented 60-40 portfolio. Absolutely there will be. When the really bad periods happen for 60/40, they're much worse in terms of consequences than the really bad periods for global risk parity. That really is over time, not sustaining those types of losses compounds to add up to a material improvement in long-term performance. Any questions on that?
So, how many assets did you have how many assets you had? 12 or 13?
Yeah, so we don't have long-term data on all of the assets that go back that far. For example, we only start getting data on international bonds in the mid-1990s, emerging market bonds in the mid-1990s. But we've got good data that goes back for most of the asset classes for most of the period.
Okay, so 12 or 13, and you keep them constant, or they will change in time, or there will be more or less? Or?
We add assets through time as they become available, right? So then we introduce them to the optimization.
If you have enough data.
Correct.
I see.
Yeah.
Thank you.
Yeah, good question.
So in your monthly rebalancing, what would be in the monthly rebalancing, what's the factor for your fees or transaction costs or commissions?
Yeah, good question. So we trade through interactive brokers. I don't know if anyone, I mean, interactive brokers has astonishingly low commission charges, especially for institutions. So we run an ETF in Canada. We run a fund in Canada with about $200 million of exposure. So, and it's fairly high turnover. So we get the absolute best institutional transaction rates. So I think last year our mutual fund, which turned over, I want to say 700% in the year, incurred about 30 basis points of trading costs, 0.3% of trading costs. That's built into our live performance. So that after trading costs, and actually also net of fees, the performance that I showed, the live performance.
Aren't spreads much more important?
Oh yeah, well, they are for stocks, but for ETFs, the ETFs that we trade, for example, the Treasury ETF, typically on average, the Treasury ETFs constitute 25 to 30% of the portfolio. Well, IEF and TLT trade at penny spreads. We use algorithms when we trade, so we actually end up almost making money on the trading itself. So all of the assets that we are allocating to have penny spreads, and we're able to trade them effectively. Yes?
Just a point of note is, at least some of you know, I do most of my algorithmic trading at a house named Folio Investing, where effectively you pay, I think it's $300 a year, and that's your total commission cost if you use what they call window trades. So I've been trading this algorithm for 5+ years. There, on your once per month, you can buy partial shares of ETFs, just like in a mutual fund and so on. So if you're interested in that sort of capability, come talk to me. For an individual investor, it's a really cheap way to go if you're interested in this sort of trading.
Thank you. That's fantastic advice. Yeah.
In the back.
Yes.
So it seems to me the simple way to think about this is if you want to have a set it and forget it kind of approach to investing, this makes a lot of sense. But as you point out, there are significant periods of underperformance of this strategy. So if you're paying attention, why would you choose this?
Yeah, so I guess what you're referring to is tracking error preferences. So I mean, this is a fairly well-documented effect. People pay special attention, for example, to their home market, and it's painful. It's painful to underperform your home market for 2 or 3 years at a time. You go to dinner parties and everybody's, high-fiving each other, and and heavily enthusiastic about what their portfolios are doing. And meanwhile, you've delivered your, average 8% or so returns pretty well every single year. I've got a really good example of that. So we run a private client business in Canada, and now we run one in the US as well. But in Canada, in 2013, our strategy delivered an 8% return. Well, markets did very poorly in Canada. And so at the end of the year in December, the reviews that I had with clients were spectacular. They absolutely loved us. We were absolute geniuses. And at the time we said, well, this is what happens. This is what happens every year. So just get used to it. And then in 2014, then when markets were ripping, well, we did 8% again. And clients came in and were irate. What happened? Why aren't you keeping up? And so we did exactly the same thing both years, and we did exactly what we said we were going to do. But I agree, it's really hard to underperform for 2 or 3 or 4 years at a time. And with a diversified strategy, you will absolutely go through 3, 4, 5 year periods where you're underperforming whatever the current dominant thing that everyone's watching. But if your objective is to generate long-term, resilient, stable returns above a certain target that you need to hit your financial objectives, then I guess that's the type of pain that you need to endure, emotional pain that you may need to endure in order to be able to realize your own personal financial objectives. Is that fair? I'll take that.
You know what? I want to give it a shot. Sure. So let's move. Hello, can you guys hear me? Let's move away from tracking error for a second and talk about. Look, I have some foresight. If I'm paying attention, and clearly the S&P 500 is a place to be over the next 6 months, then I want to be able to inform my portfolio away from this, which is about not forecasting, towards something I feel I have an edge on, right? So you want to pay attention, you want to move away from this. So the next question is, how confident are you in that estimate, right? If you're 100% confident, then you should have 0 of this and all of your money in U.S. equity. But there's a range, right? We call it the hubris scale. Hubris. It's my Peruvian scale. And so you need to self-assess what your level of confidence is. And if you're 50% confident that the S&P 500 is the place to be, then a good approach may be to put 50% of your portfolio in U.S. equities and the other 50% in a non-biased risk parity portfolio. If you're more confident in that, then you just change it, right? It depends on whatever instruments or heuristics you're going to use in order to assess how good you are at it. So yeah, you're totally right. If you have any level of prediction, you should use that. And we're going to talk about our predictive powers in a second.
Yeah, no, that's exactly right. Yeah, it's not an all or nothing. Yeah.
How do you get your weightings in your adaptive portfolio?
Yeah, so specifically, we use a combination of different types of risk parity methods. There's several different ways you can do it. But a simple way to do it is to use something called equal risk contribution. You can run it in Excel. And you can take something as simple as sort of the past 60 days of volatility and the last 252 days of correlation. There are better ways to do it, but that's a satisfactory way to do it. And you plug those volatilities and correlations, or together, covariance, into your spreadsheet, and it'll spit out the optimal weights to keep the portfolio maximally diversified and in the appropriate balance. Does that answer your question?
Not really.
Oh,
I mean, you put in correlations and
volatility.
You go through your risk analysis and things of that sort. But then it comes out with a number, okay? So it has a number, and then you are developing what? Some ratio of all those different numbers to each other, or?
Yeah, it'll literally say, let's say I have 3 assets, and I'm measuring the volatility and correlation between the 3 assets. It will spit out hold 50% asset A, 65% asset B, 20% asset C. Pardon?
Okay.
Yeah. Okay, perfect. Yes.
How do you pick A, B, and C?
A good question. So a good starting point is the global market portfolio, right? I mean, we could literally, and maybe we will at some point, go right down the rabbit hole for hours on how we might define asset classes. There are actually mathematical ways that you can measure the marginal diversification properties of adding different levels of granularity of asset classes. So for example, should we hold copper and oil and gold? Or should we take oil and copper and hold them together in production weight, along with all of the other major commodities, and make that a diversified commodity basket? Should we separate gold out? There are ways to measure the marginal benefit of breaking them apart versus aggregating them, which I'd be happy to explore with you at another time if you'd like. But at the very least, you sort of start with global stocks, so MSCI, AAII, for example, some global bond proxy like the Barclays Multiverse, and a diversified commodity basket that includes gold, right? So that's kind of that's the highest conceivable level, I think. And then you can start breaking apart the equity basket, for example. So should I just divide it into US and ex-US? Or is it useful to do US, Europe, Pacific, emerging, right? And you can do the same thing for bond markets. You do the same thing for commodity markets, REITs, exactly.
Do you guys do that, or do you wait for Morgan Stanley to do that? That's a massive combinatorial analysis.
Yeah, it's not as large if you start from the top. If you start from the bottom, it's an intractable combinatorial analysis. But if you start from the top and you start breaking them apart, then you just reach a point when it no longer makes sense to break them apart, and you stop there, and that's what we've done. Yeah.
Do you consider volatility to be one of these asset classes? And I mean the VIX.
We trade it for our alpha strategies in a very, a manageable sliver. The funny thing about volatility is, as an asset class, this is a bit of a diversion, but it's got very high steady returns until it completely wipes out your portfolio. So it's the perfect turkey asset, right? But the funny thing is, if you use volatility strategies as a sleeve in your portfolio and you maintain a constant size of that sleeve. So imagine you've got 90% 60-40, 10% volatility. And you just know at some point that 10% you've got in the volatility strategy is going to zero. You'll wake up one day, that's going to be zero. But in the meantime, you can keep siphoning returns off that 10% sleeve, right? So you just keep it at that 10% level. It's continuing to generate returns. In order to keep it at 10%, you got to take money out of the volatility sleeve and move it into the other sleeve. So you're continuing to harvest these gains. And then when it eventually goes to zero, you rebalance, you top up your volatility sleeve again, so it's now at 10%. And by the way, for the few years after it goes to zero, the returns of the volatility strategy are going to be off the charts. If you've got the capital left and the conviction to rebalance back to your original weight. Is that satisfactory?
Yes.
Perfect. Now we're going to get into some of these strategies that we might be able to use to forecast returns. And so who's, at least if you don't use them, who's familiar with some of the main alternative risk premia or alternative factors, excess return factors? Value, quality, low volatility. Anyone? Yeah, a few, okay. So there are very well documented in the academic literature, in the practitioner literature, examples of ways that you can generate returns without any exposure to traditional asset classes. Typically, those return factors, we call them factors, are formed from going long a basket of stocks that contain a certain favorable quality and going short the same dollar value of stocks that contain the same unfavorable quality. And so you've got zero exposure to the market, and you're exclusively depending on the way that you sort the stocks to generate the returns. So as an example, the academic literature says that there's this value factor. And if you were to buy the top 10% of stocks in the US market, in any market, this works in any market, buy the top 10% of stocks that have the highest book value relative to price, and you were to short the lowest 10% of stocks that have the lowest book value relative to price, then over time you will earn a fairly substantial premium. What is the size of that premium? Well, at 10% volatility, you get about 5% annual returns from exposure to this value factor with no exposure to markets. There's a momentum factor, which the very fathers of efficient markets, such as Eugene Fama, has himself declared to be the premier anomaly, the premier factor. And this is just take the top 10% of stocks that have performed the best, have the best performance over the past 12 months, minus the skip month, and go short the stocks that have had the worst performance over the past 12 months, minus the skip month. Well, that portfolio with no exposure to the market would have delivered almost 6% annual returns. And then there's the low volatility or defensive or betting against beta factor, which is a strange phenomenon where the lowest volatility stocks end up having the highest returns, and the highest volatility stocks end up having the lowest returns. And so if you go long the top third of stocks that have the lowest volatility and short the bottom third of stocks that have the highest volatility, and in this case you've got to scale the exposure to both those baskets, because obviously the high volatility basket is way more volatile than the low volatility basket. So you've got to scale them so they have the same risk. But that portfolio earns a dependable premium. Those are fairly well known. There are other ones which end up actually being the most powerful ones. One's called carry. The carry on an asset is the return that you earn if the price doesn't change. So in stocks, the dividend yield is the return that you earn if the price doesn't change. So the carry of an equity portfolio is the dividend yield. The carry of a bond portfolio, bond carry is you borrow at the low maturity end of the yield curve at like 1 month rates, and you invest in the 10-year rate, and you earn a premium because the 10-year rate is usually higher than the 1 month rate, right? So the carry is the difference between the 10-year rate and the 1 month rate. That's the bond term carry. Commodities earn a carry because of the way that they roll up the futures curve, the cost of storage, that sort of thing. So every major currencies earn a carry. There are some currencies in countries that have very high short-term rates, like Australia. And then you've got other currencies with very, very low short-term rates, like Japan. And so you can borrow in Japanese yen and pay the yen interest rate and invest in Australian bonds that earn the Australian interest rate. Okay? None of these are without risk. You're taking on risk when you do all of these strategies. They're risky strategies. But the risk is compensated with an excess return. And then there's a trend factor, which is similar to momentum, but instead of sorting stocks based on which ones are the best and which ones are the worst, instead you're evaluating the price of a stock relative to itself in the past. So you want to own an asset that has gone up recently and go short an asset that has gone down recently. This is the trend factor. Now, most people think about these factors in terms of how to deploy them on baskets of stock portfolios. But you could just as easily deploy these factor strategies on asset classes. For example, going long the country equity indexes using ETFs or futures, going long the country equity indices that have the highest dividend yield and short the ones that have the lowest dividend yield. Or going long the asset classes that have the highest short-term return, the best trends, and short the ones with the worst trends. And so it turns out if you apply these factor strategies in a multi-asset context, that you actually do better than you do in a stock-based context. And I could provide a few reasons for that. Number one among them is that markets, as Paul Samuelson, who won the Nobel Prize in Economics, said, markets are micro-efficient but macro-inefficient. In other words, at the security level, 99.9% of all cognitive and computational energy in markets is focused on picking the best stocks and bonds. 99.9%. Very, very little energy is focused on trying to divine the best asset allocation that changes through time. Right? And there are very substantial barriers to arbitrage. Most advisors don't have the compliance latitude to be able to be as active with asset allocation. Institutions have to answer to an investment committee, a board, that meets once a quarter. They can't be agile. They've got to report to an actuary about the expected returns on their strategic portfolio. They can't react in real time to changes in asset allocation. So in order for there to be a persistent source of excess returns, well, there's got to be, first of all, investors behaving badly in some form, which I call the willing losers. I didn't come up with that. That was what's his name from Research Affiliates? I can't remember his name. Not his issue. The Rob Arnott from Research Affiliates. But people who are expressing non-wealth maximizing preferences, like home buys, for example. I have a strong preference to be comfortable and invest in things that I know I drive by every day. That is a perfectly reasonable preference, but it's not a wealth maximizing preference. And so there are a variety of other preferences that people express that lead to these types of outcomes. And investors who are not vulnerable to those preferences are able to take the other sides of those trades and earn a premium. Now,
question.
Yes.
I noticed that you don't have small cap versus large cap listed there.
Right, yeah. So that's a complicated one. I could have listed it. So this idea is that small caps on average over the long term deliver higher returns than large cap stocks with higher risk. Specifically, small cap value stocks have delivered quite a bit, higher returns with quite a bit higher risk than a large cap diversified portfolio. Unfortunately, the small cap effect doesn't hold outside of the US. So it's one of these strange anomalies. The way that I evaluate the merits of these strategies is, first of all, do they have intuitive grounding in economic principles? Can we source an alternative set of preferences that have led investors to behave badly in a way that we can consistently capitalize on? Are there sufficient barriers to arbitrage so that these sources of returns will be sustainable in markets? Is there sufficiently pervasive evidence of this across all major markets? Is it persistent through time? Do we observe the effect across multiple time periods? And is there demonstrable evidence that we can capitalize on these effects after costs, right? And the fact is that small cap investing on its own, without a quality or value tilt, doesn't satisfy all those different criteria. So I didn't include it. Okay. Now, why do we even talk about these alternative sources of return? Well, primarily I talk about it right now because the available returns on a traditional portfolio are particularly unattractive. And so we have a situation, anyone here familiar with this chart? Have you seen this chart before? Yeah. This chart plots the return that's expected relative to risk for a variety of different portfolios. So just configuring different portfolios of asset classes. Well, there's a configuration of assets that will deliver the highest possible return at each level of risk. And if you plot that function, you get a shape like that. And so and this is just illustrative, I haven't actually used any real returns here, but the blue line there is an illustrative traditional portfolio that just uses stocks and bonds and takes advantage of the diversification properties of stocks and bonds. But then what's possible if you introduce other sources of excess returns that are not correlated to the existing traditional sources of returns. And the great thing about these factors is that they have a very low correlation to the other major assets in your portfolio. Now I want to do, anyone here allocate to like a value ETF or value-based mutual fund or anything like that? Is everyone here pretty old market cap based, like S&P 500 market cap? Do you run value-based strategies? Petrovsky, F-score, enterprise value, EBITDA? Anyone? Okay, yeah, okay, good. Because I think it's, yes, you have a question?
I have a question.
Yes.
So the basic key of your success is the correlation. But the point is, how do you validate all your assets are not correlated? How do you measure that?
Yeah, so we measure it on an ongoing basis. We measure it all the time. We are measuring the correlation, and we measure it in a variety of different ways, over a variety of different time horizons, and at a variety of different frequencies. And we sort of take an average of all of those estimates. Pardon?
What kind of range of your correlation?
Well, I don't know if you're here for that the chart where we plotted the range of correlations between just stocks and bonds over the long term, and it ranged from minus 0.5 to plus 0.5 over the time horizon. So it can be very, the range can be very wide and have a pretty substantial impact on the volatility of the portfolio. So we need to measure it constantly and adjust the configuration of the portfolio so that it's constantly aligned with the current estimates of volatility and correlation. Does that make sense? So we're changing the configuration of our portfolio all the time because the correlation and the volatility are changing.
So one of your examples, bond and stock are not correlated.
Sometimes they are correlated, sometimes they're not correlated. We won't know whether they're correlated or uncorrelated unless we measure it. And so we constantly measure it to see if we just take we just measure the actual correlation of the returns using a computer. Yeah, yeah. This may not be as useful as I thought it might be. I'm gonna skip this because if you guys don't use a lot of smart beta ETFs, then it's probably not very useful. But I want to zero in on two strategies that the two strategies that had the highest returns: the carry strategy, the multi-asset carry strategy, and the multi-asset trend strategy. Right. So these at the same level, 10% volatility, have about an 11% return. Yes.
What's the time frame for your trend?
In this case, it's just 12-month trend. I just use the academic definition.
That's what you said for momentum, isn't it?
Yeah, the momentum is it's the same. It's just with momentum, you're sorting the top versus the bottom, whereas trend is just, is this particular instrument going up or going down? That's it's tough to conceptualize, but that's the difference. Right, so we're just going to zero in on picking assets that have high carry and going short assets with low carry, and also picking assets with great trends and going short assets with very negative trends. All right, we're going to zero in on those techniques. So this is the long-term return trajectory for a carry strategy in dark blue and a trend strategy in light blue. And you can see that they both delivered gross returns of about 13% per year with a Sharpe ratio of about 1. So For every unit of risk that you're taking, you're always also getting 1 unit of return. So a very attractive profile. Again, stocks and bonds have a long-term Sharpe ratio of around 0.3 individually and 0.42 together. So this is a very attractive strategies. This doesn't account for costs. So we can cut it in half, probably after costs. But either way, a very attractive return profile. And it's also attractive for the reason that it's they're both highly uncorrelated to one another and uncorrelated to a diversified global portfolio. So I included a correlation matrix here. You can see that carry has a correlation of 0.29 to risk parity, 0.25 to trend, and the trend has a correlation of 0.19 to risk parity. So these are reasonably uncorrelated over the long term. Not perfectly uncorrelated, but reasonably uncorrelated. And so the question is, we've got 3 strategies, each of which has a pretty darn good risk-return profile on their own. Well, can we combine them? Because the holy grail of investing is in combining uncorrelated sources of return. So here's a portfolio that derives 2/3 of its risk from a global risk parity strategy, just a simple global risk parity strategy. The data that we have for trend and carry only go back to 1991. So I just used this from 1991 to today. Here is 2/3 global risk parity, and then 1/3 in a combination of trend and carry. Right? And you can see that, well, at a 10% volatility, again, it's got a pretty darn attractive risk profile, about 16% returns, and Sharpe ratio of 1.3, and a maximum drawdown of about 16% over 25 plus years. Yes?
So you, even with carry and trend, those factors, you still limit the risk to 10%.
Well, just in this example, many people would, I think, struggle. Well, just to this gentleman's point, they struggle enough during underperforming periods relative to a typical S&P 500 strategy or a U.S. balanced strategy. As you continue to add more uncorrelated strategies, then the probability of looking different from your home index just gets bigger and bigger. And so there's some balance in there between the true mean variance mathematical optimal portfolio relative to the portfolio that you can stick with. The best portfolio is the one with the highest Sharpe ratio that you can also stick with. Sorry, I missed one piece. Is the portfolio that meets your required return with the highest Sharpe ratio that you can stick with. That's the absolute ideal portfolio. And a lot of people can't stick with a lot of tracking error. We partnered with S&P to create an index that uses both trend and carry. In this case, what we're doing is we are forming a risk parity portfolio over that same universe of global asset classes that we were talking about. And we're using ETFs. So absolutely implementable cheaply. And once we form the risk parity portfolio, we're reducing exposure to asset classes that have lower carry and negative trends. And we're increasing risk exposure to assets with high carry and high trends. Yes?
So these are great examples. In the most recent Michael Lewis book, The Undoing Project, which kind of explores the 2 guys.
Huge fan, yep.
Yeah, cognitive bias and all the research in different fields. There are a number of fields in which experts or people who think they know something dramatically underperform systems, algorithms.
Yes. Yes.
So with this, we're a room full of potential experts. How are we going to underperform?
Yeah, I'm not sure I interpreted that right, but so I wonder if I should get into it. Does anyone here know of Philip Tetlock? Ever heard of Philip Tetlock? Okay, perfect. I may pause for a minute and tell this story because it was absolutely transformative for me. So I came into the global financial crisis thinking I was an expert, particularly global macro, on the commodity bandwagon. I knew everything there was to know about how Saudi credit default swap spreads predicted oil returns and the returns to currencies with heavy oil-related economies. I knew about the crack spread between heavy and sour crude, and that was how I was making investment decisions. And right through 2008, I was tearing it up until mid-July 2008, when oil peaked at around $150 and began to crash. I was short bank stocks. Helped a little bit, not nearly enough. It ended up having a very bad year. And that really was the catalyst that led me to take the approach that I'm currently taking. But it was at this time, when I was particularly receptive to the message that you're describing there, that I stumbled on a video by a guy named Philip Tetlock. And so Philip Tetlock graduated, I think from Yale, could be wrong, graduated from Yale in the 1980s and went to work in these Washington military think tanks. And his role there was in basically note-taking. And then he'd have to come to the next meeting in the next quarter and recite the minutes. And what he realized as he was taking notes and then he'd go to the next meeting was that all these top generals and top military strategists and intelligence officials, et cetera, they would make a prediction about what was going to happen in the, what's going to happen with Yeltsin in the Politburo or what have you. They'd make this prediction, and it wouldn't play out at all like they expected. And so, and this happened over and over and over again. And what would happen is that these experts would come back in, and then they would present the counterfactual. Well, it would have happened if only this other person hadn't stepped in, and they didn't have a storm, and So they would always have an excuse as to why they were wrong, but they were always wrong. And so Tetlock decided he was going to go back to university, and he was going to make it his life's work to study decision-making under uncertainty. And so he spent 15 years. He recruited 200 subjects, and he asked them each about 100 questions. They were very specific questions on economics, on foreign policy, on military strategy, on various intelligence topics. But they required very specific answers. Will inflation exceed 2.5% in the UK by 3 years from now? What is how confident are you in your answer? And obviously a perfectly calibrated forecaster, well, if he said when he says he's 70% confident that something's going to happen, over the long term, over many guesses, that thing happens about 70% of the time, right? It's a perfectly calibrated forecaster. And then he aggregated all these results. So 18,000 different forecasts from 200 people. By the way, what do these people look like? Well, average 16 years of experience, average master's degree, average 10 or more published papers. Like, they are legitimate experts in their fields. So what did he discover? Well, first of all, he discovered that the experts were less accurate in their forecast than might be expected from random guessing. That there were no outliers, not one outlier among all 200. Not one. The people who were published in the most journals, who appeared the most in TV and appeared the most in the press, were statistically significantly less accurate in their forecasts than the experts that toiled in obscurity. How's this for one? The experts making guesses outside their field of expertise were more accurate than the experts making guesses inside their field of expertise. Alongside these experts, Tetlock used some very simple algorithms to also make forecasts. The algorithms were, in the short term, assume that the current trend will remain in place. Over the long term, assume that the dynamic will return to its long-term mean. Now, for those of the factor orientation, you'll notice that one is trend and one is carry or value, right? And so it was that recognition at that time, after that experience for me, that set me on this path. Is that useful? All right.
So we should listen to Jim Cramer.
Don't even get me started. Don't even get me started. But I legitimately think that you need to go through 3 major crises in your investment life before you wake up to the fact that you need to do things like diversify. I was a trader on the trading floor in 1998 when long-term capital needed to be bailed out. I had a very, very bad month. It was subsequently escorted out of the building. And in 2000, I had made all kinds of grand proclamations about why all these tech companies should have been valued where they were, and ended up being dead wrong. I was dead wrong in 2008. It took 3 frying pans to the face to lead me to the type of strategies that I'm here to talk to you about today. So just to come full circle, this index, we launched at S&P. You can download the data from S&P, and it applies global risk parity with a tilt towards trend and carry. And you can see from the long-term performance from 1991 that it achieves about the same Sharpe ratio, about 1.26 units of return per unit of risk, and a very pleasant risk profile, with a maximum peak to trough loss over the period that was less than 10%. Now, I'm not here to suggest that this is a return that you should expect on this strategy going forward. I think you're probably going to get the same returns on this strategy as you get from an equity portfolio, a global equity portfolio. But what I am very confident about is that you'll get those returns at very substantially less risk than you have to endure from an equity portfolio. Why does this matter? Anyone here familiar with the work of Moshe Milevsky in the retirement space? Yeah, Moshe Milevsky? Great. So Moshe Milevsky works at the Fields Institute in Toronto, which is where we're from. So I've had occasion to spend some time with Dr. Milevsky. We use his approach. This is a simple approach. Well, not simple, but it's laid out simply in a paper called The Calculus of Retirement. And it shows the safe withdrawal rate that can be supported based on a certain level of expected returns and a certain level of portfolio volatility. And the mathematical reality is that if you have 2 assets with the same expected return, and one of those assets has substantially lower volatility, then you can support a much higher income using the asset with the lower volatility than you can with the asset with the higher volatility. As an example, if we expect this global risk parity strategy to deliver approximately the same return as stocks over the long term, but to do that at a volatility of 7% instead of 16%, which is the long-term volatility of a stock portfolio, then it can support a 7% distribution rate relative to the 3.5–4% distribution rate for stocks. That is where the rubber hits the road. That's why I keep harping on the importance of delivering stable returns and low volatility. Looks like you have a question. No? Okay, maybe not. There was a confused face, but does anyone have any questions about this chart or about anything so far?
Could you give the reference again, please?
Yeah, it's the Calculus of Retirement Income from Moshe Milevsky. It's an inverse gamma distribution. He lays it all out. Moshe Milevsky.
His books are very good.
They are, yeah.
What's the title?
Pardon?
What's the title?
Oh, this is a paper called The Calculus of Retirement Income.
Question.
Yes.
Getting back to what you said before about how you can improve your gains by going long stocks with the best momentum and shorting the ones with the worst momentum.
Yes.
How would you short the ones with the least momentum is there an ETF for that?
No, unfortunately not, no. And so it actually is very difficult to implement the factor strategies as an individual investor. You pay high margin cost and you get really not very good trading fills. So I wouldn't suggest, I think there were some ETFs that tried to implement them and they didn't really go anywhere. So.
Well, how do you do it? Do you do it with individual stocks?
I don't do it at all. We use trend and carry, and we do use a momentum, as Rodrigo's going to talk about now. We do use momentum. Once we identify stocks with good trends, then we do emphasize the ones with the best trends and de-emphasize the ones with the worst trends. But it's at the asset class level, not at the individual stock level. Yes.
So you have a basic view that all assets are going to go up.
Right.
You have a basic view that all assets are going to go up.
Yes.
Do you use inverse ETFs at all?
We don't use them. That's not true. Our volatility strategy uses an inverse ETF. But no, otherwise no. And we don't use any levered ETFs either, because there are some very profound negative compounding mathematical effects of using levered ETFs rather than just using leverage on the portfolio itself. Anyway, Rodrigo. Rodrigo's my partner, has been a business partner for 6-7 years now. And so to save my voice, he's going to talk about our adaptive asset allocation approach.
Thanks, Adam. Everybody hear me?
Yep. Cool.
I just want to test something out here. All right, so we'll just go with that. All right, so what I'm going to cover now is taking it a step further. So Adam's covered risk parity. He's covered risk parity with a slight tilt towards carry and trend. What I'm going to discuss now is our flagship solution, the adaptive asset allocation strategy. And really, what we're going to do is take the carry and the momentum, and the carry and the trend into an even further step, be more concentrated. Okay. And the way we like to do this is to start with a simple portfolio, 10 asset classes. We make this example exactly the same as what's in the brochure that we handed out. And this is just to present the concepts stepwise. We're going to start with 10 asset classes to make the math easy. The first step is to say I want to go global because diversification matters. By going back to the machine that Adam was talking about, if we assume that we can't predict anything and that we don't even know what the market cap weight of the portfolio is, the best way to start is to assume an equal weight portfolio across these 10 asset classes. And what I'm going to look at then is I'm going to apply some volatility filters, I'm going to apply trend and carry filter, then I'm going to apply correlation filter and see what happens. So this is the typical universe that we've been talking about. You have a bunch of equity asset classes, you have some real estate, some treasuries, some commodities, some gold. And if we were to create a portfolio from 1995 to 2015, which is what's in the brochure there, and rebalance back to 10% at the end of each month, what we would get is a fairly typical profile, very similar to a balanced portfolio, right? So you're looking at 7% volatility, 7.5% rate of return, 11.5% volatility. An important factor in terms of having a more consistent return, a safer withdrawal rate during retirement is how often am I sitting down with you or you're sitting down with your portfolio and seeing that you made money over the last 12 months, right? So 12-month rolling returns is important. In this case, 77% of the time you're making money, 23% of the time you're losing money, and some of those periods are negative 37%. That's the peak to trough loss of this portfolio. And of course, you have the tech crisis here as well. You guys can see the cursor, right? Okay, cool. All right, so going back to reviewing what Adam talked about, is this idea that if we don't know anything, we're assuming that every one of these asset classes is going to contribute the same. It's going to have equal contribution to the portfolio, right? They're going to do their best or their worst equally. But the reality is that we're letting the maniacs take over the asylum, right? We're letting asset classes like emerging markets really dominate the risk of the portfolio, while 10-year treasuries aren't really improving much in terms of diversification. They're not able to have much impact. And so when we simply measure, in this case, and what we wrote in the brochure, we're just looking at 60 days volatility. The average 60 days volatility of each of these asset classes, that volatility is then measured. And if the volatility contribution of these asset classes are above 10%, then we're going to reduce the allocation. If it's below 10%, we're going to increase it, right? Simple, straightforward steps that you can take in order to create a more balanced portfolio. And you can see that every month they're going to change because volatility changes over time. And on August 2012, you can see the biggest allocations to 7-10-year treasuries. So at the end of each month now, we are going to rebalance, but we're going to rebalance based on risk contribution rather than dollar amounts. And the point of this is not really to blow the lights out. The point of this is to try to grab those building blocks that the global market offers us and see if there's a way to get the same type of return, but make the experience better, right? Reduce the drawdown, reduce the volatility. If we can achieve both, why not? Rather than just keep it in an equal weight portfolio. You can see that the improvement is a slight improvement in return. Volatility is massively reduced from 11.5% to 8.7%. You're looking at 84% of 12-month rolling periods, and your max loss is negative 22%. And all we did was just measure volatility.
So have you run it if you rebalance quarterly or annually instead of monthly?
Yeah, there's improvements if you do it quarterly. There's improvements if you do it annually. There's improvements, from a traditional equal weight portfolio.
Is monthly optimal in terms of rebalancing?
The optimal point, so we do it every 2 weeks for our clients' portfolios. That's what we consider to be optimal from a trade count perspective, and just keeping the signals as fresh as possible. But there's there's consequence to the cost of trade depending on what your cost of trade is, and there's consequence to the taxes that you're going to pay depending on what version of this you're going to implement. And so we have decided on 2 weeks. Okay. So the next thing is, we played a little defense here. Can we play a little offense, right? And offense is really just another word for saying, hey, do I have a view? Can I predict a little bit of where these asset classes are going to go? As Adam alluded to, there's a bunch of ways to do it, but the two most persistent and consistent ones are carry and trend. They also create a more stable profile, right? Where you compare it to value, for example. The thing about value is you're going to get a lot of great returns over a long period of time, but you can have many, many years where you're just waiting for that return to come. It can be flat or down. It's very volatile. It's not consistent. Well, with carry and trend, it actually is quite persistent. And so what we're going to do here is we're just going to make it easy. We're going to grab the asset classes. We're going to rank them based on these metrics over the last 6 months. And we're going to keep the top 5 best carry and best trend asset classes, and we're going to eliminate the bottom 5. And so at the end of every month, we're going to do that. We're going to have 5 asset classes, and then we're going to do inverse volatility. So we're going to make sure that each one of them contributes the same amount of risk to the portfolio. So we apply rule number 1 and rule number 2. Now that offense kicks in, and we are better able to transition to those asset classes that are likely to do well over the next rebalance period. You're looking at, yep.
Earlier, Adam was talking about 12-month trend, I think.
Mm-hmm.
This has got 6-month trend.
Yes. We'll talk a little bit about what that is in the next section. Right. So this is, again, what we're trying to do with this is to introduce these concepts and keep the rules simple. What we do in live trading is a bit more complex than that for a reason, to make it robust. But yes, you're right, and we'll talk about that 6-month period. But in this case, assuming it's 6 month, proof of concept, clearly this is an improvement. One thing we haven't considered yet is the co-movement, right? So Adam was talking about the machine looking at volatility, looking at a return estimate. Now we're looking at co-movement. And this idea that if we are able to estimate the correlations between these asset classes, is there an even better way of creating balance across the portfolio? And that seems to improve the outcome a bit more. Right? So at the end of the day, with this simple 6-month top 5 portfolio, you're looking at better returns. The drawdown goes way down, 98% of 12 months rolling periods. And if we're rebalancing every month, we target 8% volatility, what you get, I don't know if you guys can recall the risk parity transition chart, it was much more, you were always holding one asset, all asset classes. In this case, the system is completely eliminating asset classes altogether, right? So in a period like the 70s, where risk parity did okay, with this system, you would have transitioned even further towards gold and commodities, and then even better, right? So that predictive ability is there. And these white areas also happen to be the periods where the portfolio, the adaptive asset allocation portfolio had a volatility above 8%, and it required some cash to cool it down and keep that risk profile, to maintain that risk profile.
No asset class can ever exceed 20%?
No. As you can see from the purple area at the beginning there, the asset classes there are 80%. So there are periods in this example, in this simple example of 6-month look backs, we're going to see some concentration. So we do not limit the concentration of the portfolio. So one of the things that a quant struggles with, anybody that, Adam said it already, that I've never seen a backtest that I didn't like. This is a common theme. You got to be very afraid that the system that you have just built, the moment that you start running live money with it, is not going to fall apart, right? How do you do that? How do you assess whether something is going to be persistent? Well, one way to do it is from just a checklist standpoint, is what Adam alluded to, which is looking at something that makes intuitive sense, right? That intuitively we can understand why trend works. It works because we're humans. We have herding behavior. There's a ton of academic work done by Danny Kahneman and Amos Tversky, which was featured in the Undoing Project. That can give us intuitively that trend is likely to continue to work for those reasons. So intuition is important. The ability to see this work across many asset classes and many markets, the ability to work across time, the fact that you can implement it after fees, and so on. So you start with that checklist. If that makes sense, great. But then another way to do it is to have final validation is you test it on a universe or a time frame with some data that you have, and then get presented with a different set of data that you've never tested it on. And if it falls apart, then you clearly data mine something. It's not real, right? And we did a lot of that work, but also a couple of academics. I don't know if you guys know Isla Woodward Keller and Isla Kipnis, 2 PhDs that do a lot of this type of work. They reached out to Adam and asked him to help them out with this white paper. They were trying to do the adaptive asset allocation framework, but they had data going back to 1915, which we'd never seen before. And so Adam hopped on board and decided to co-author this white paper. And what these 3 lines represent is the dark line is the equal weight portfolio of 25 global asset classes. The green line is basically the adaptive asset allocation framework at 5% target volatility, and the red line is 10%. And so what you see here is an annualized rate of return of 15%, the volatility targeted at 10 hits 10, and the maximum loss being negative 22%, which happened to be during the Depression. And you contrast that with an equal weight portfolio, which has a 63% max loss, right? So this is validation that this is not a system that all the theoretical frameworks that we had that had allowed us to feel confident in this system played through the previous century. And so this gave us even further confidence that what we had was something of value. Regardless, from a backtesting perspective, what we're trying to do is we're trying to grab those theories, that idea that we are herders in the case of trend, and say, okay, well, how do we extract value How do we pick up the money that those willing losers are leaving on the floor, right? There's multiple ways of doing it. We can talk about looking back at 12 months and saying, I'm going to look back over the last 12 months, and if you're above trend, then I'm going to buy you. Below trend, I'm not going to buy you. Well, what's so magical about 12 months? Why not 6 months? No, why not 20 days, right? And what we find is that trend actually exhibits anywhere between 20 days and 250 plus days. So any one of those are just as valid, right? So what we don't want to do as a quantitative shop is be specifically wrong. We don't want to go back and test all those different lookbacks and say, aha, it was 9.2 months. That gives us a annualized rate of return at 23% with a Sharpe ratio of 5. We're going to run with that because that's being specifically wrong. That's the definition of curve fitting. Right? What we know is that that one isn't going to be the best performing one over the next 5 years. So we want to capture and extract that momentum, that carry, that trend effect wherever it may lie. And it lies between 20 days and 200, 300 days over the last 800 years. Right? This has been, there's a paper that kind of shows that this trend in carry exhibits itself over, wine markets, real estate, all types of markets. And so you want to take a wide swath of metrics in order to extract that signal. Now, we're also looking at how we put the portfolio together. The portfolio, we're talking about a risk parity optimization or a mean variance optimization, where it just so happens there are multiple ways of creating the optimal portfolio. Which one's best? Should I pick the best performing one? Of course not. There's a multitude of ways of doing it. So I think they're broadly correct, right? So I want to try them all. I want to test them all and see what they look like. And then after I've done that testing, this is just an example, right? You grab top different types of looking at momentum or trend, different ways of creating optimal portfolios, and you get a wide variety of outcomes. Now, if all of these lines seem to have a high P statistic, the probability that these lines outperform the equal weight portfolio is high, and it's not likely to be chance. But instead of saying, I'm going to now run my business as Resolve Asset Management using the signals of this top one, is foolhardy, right? Because number one, we actually benefit if all of these are doing a good job of extracting the signal from the noise, or that momentum signal, and they're all statistically significant, why not put them together? They all seem to have relatively low correlation to each other. As we know, what we're trying to achieve here is as many non-correlated asset classes as possible. So even within the carry and the trend and the optimization, those different ways of attacking the problem have non-correlation to each other and allows us as a gestalt to increase the Sharpe ratio. So we take the approach of averaging all those out. And when we average all those out, the sad part is that I can't go out and market a phenomenal back test that's going to have a 5 Sharpe. But it also means that what I do go out and decide that I'm going to run as a system, in our case, we run adaptive asset allocation is actually 41 different systems put together, 41 different approaches I put together. What that allows us to do is that whatever we've tested, we have a high level of confidence that it's going to resemble what we're going to see in the future. If that makes sense. Right, so that's this, to your question, why 6 months? Yeah, that was just to keep it simple. And I just put these slides in just to kind of show the value of being adaptive and constantly refreshing that portfolio. And then starting to introduce a little bit of the targeting that we've talked about, that 8% volatility targeting that we've talked about so far has been the fact that if volatility goes above 8%, that we add cash to cool it down so we can keep that profile for clients. Well, the flip side also works, right? Sometimes the portfolio that we've created is so diverse and has such low volatility that we're giving a 5% level of volatility. Well, that's not what you signed up for. That's boring. You signed up for 8 or you signed up for 10, right? So what do you do now? Well, it's the opposite. 10 divided by 5 is 200%. Maybe you should use a little bit of leverage in order to hit that target. You're not taking extra risk. You're taking the same level of risk you signed up for. Now you're taking more risk than you would if you weren't levered at 5%, but you want 10. You're okay with 10. Use some leverage. So this part here, this section here, and we'll get into leverage in a second, is the exposure from 100% to 150%. So you can see a 10% volatility adaptive asset allocation evolves through time. In 08, it goes into cash. This is just an example of how it can transition. And if you're able to consistently adjust your return estimates, your correlation volatility estimates, even in periods like 08, you give yourself a chance to not only do better, but provide maybe a couple double-digit returns, like we did, like the system did in this case.
So in your model, using asset classes instead of individual stocks, the two most likely, so two common mistakes where you would find lots of willing losers are people who buy high and sell low. So as the bull market continues, more and more people pile in because it's been going up for a long period of time, and then they buy high. And so maybe you'd want to do something different from that. And the other one is kind of the unwillingness to invest after a sharp drop, which suggests that where there's negative volatility, there may be opportunity resulting from people's reluctance to overcome their loss bias.
Yeah.
So how does your model capitalize on those two human behavior characteristics?
Well, in our model, right, because we are in this adaptive asset allocation model, we only pick up what the willing losers on the long end are leaving on the table, right? So those individuals that are piling onto an asset class for whatever zeitgeist at the moment that exists in the world that's forcing everybody in, as that momentum goes up, we are capturing that. Now, the difference between us and them is that when these willing losers are piling onto these prices, to these asset classes and driving up the price, most people are piling on and thinking that they're buying value and holding on to that for a very long period of time. And we are constantly measuring and willing to get out when that trend changes, right? On negative momentum, the only way to capture that or negative trend is by shorting. Now, in our alpha strategy, we do use trend and we do take advantage of that. In this is designed to be a core holding that's long only, using exchange traded funds. And so we are extracting excess value, but just on the long end. And so the numbers that Adam alluded to, all those different factors are long, short factors. We don't do that. We just take the long end for this. I think we already covered this. So this adaptive asset allocation is a very low correlation to traditional asset classes. Adam already showed you the return profile. So now I want to get into the last part of this presentation. And a gentleman came up to me earlier and said, so, I get it. You guys are trying to create diversified portfolios. What I can't wrap my mind around is the more diverse I get, the less the risk I take, the lower return I'm going to get. And I need a certain level of return, right? And it's absolutely true. This, we've been talking about Sharpe ratio. So for every unit of risk, how much return am I going to get? And our view is that you want to maximize that. But what if you have a 2 Sharpe, but your volatility is 2.5 and your return's 5, and you need 10? Well, that's a problem. Then you need to go and start taking more risk in equity asset classes in order to get that excess return, right? So let's assume that the example that we put together here is, let's grab those exchange traded funds that a bunch of them that we talked about. So I'll just kind of go through them. From the left, you have the IEF is 10-year treasuries, BWX is global sovereign bonds, TLT is long-term bonds, EMB is emerging market bonds, GLD is gold, BTI is US equities, RWX is international real estate, DVC is commodities, VGK is Europe, BPL is Asia, IYR is domestic real estate, and BWO is emerging markets, right? And these are based on kind of estimates of correlation and volatility and return. And so if you're an investor that says, look, I forget about diversification, I actually need 5%. And the best asset class that I can choose is VPL. So I have to be 100% of my money needs to go to East Asian stocks. I need it. I need the money. I need the return. Okay, so that's one option. And the thing about just having that one choice is that it's kind of not true, because there's this magic with diversification. That if you are able to identify asset classes that may have lower returns but are non-correlated to you, you might be able to create a better outcome for yourself by putting different proportions across these asset classes, right? And this is kind of going back to Adam's chart on the efficient frontier. Now, this is a frontier because at every point in that frontier, if you look at the risk profile, at every level of risk, I can put together a combination of all those asset classes that actually bumps up both my return profile and my risk profile, right? So now I can take a different approach. I can say, hey, I want to put together a portfolio that that increases my return and risk, that is diversified, a little bit more diversified, and still hits my return target, right? So if you want a return of 5%, well, instead of taking 16% rate of risk in terms of getting just 100% of your money in VPL, you can get lower risk and get the same return that you needed by being diversified. And that diversification for that point looks like this, right? So at that level of risk, you put together this portfolio and you are going to get a better rate of return for risk. Okay, so that's one way of looking at it. But we've been talking about the max Sharpe portfolio. And the way the mathematical way you do that is you actually find a tangency point between cash. You see that red line is what's called the capital market line. The capital market line starts at the left axis of the y-axis at what cash is going at right now, and then finds a tangency point to the efficient frontier. And that portfolio happens to have the highest return for the same level of risk. So for every unit of risk that I take, it's going to have the highest return profile, right? So every other portfolio across this blue line has a lower Sharpe ratio. This is the highest Sharpe ratio. And we've been banging the table on the Sharpe ratio being the most important thing, but hold on a second. I need returns over here. How can I possibly want this over that diversified portfolio you showed me before? Because the Sharpe ratio portfolio has a lot more bonds in it than I need, and I need to, bonds are going to provide me low returns, and it just doesn't make any sense for me. Well, the Nobel Prize winning concept was that, well, you don't actually need to move away from high Sharpe and high diversification and high balance. You don't need to do that. You don't need to go to more concentrated portfolio. You can actually apply leverage to that well-diversified portfolio. So that red line, when you go down from this point here, from this tangency point, if you go down, that's us using cash and going towards cash in order to cool the portfolio down if I need lower volatility. So you guys recall that we use cash in 08 to cool it down. That's us going down that line. We're not changing the constituents of the portfolio. We're merely just reducing its exposure to hit our volatility target. Well, on the flip side, we can use leverage, modest leverage, in this case, 40% leverage, to hit 5% return and 9% risk, which is significantly lower than the 13% we were getting going up the efficient frontier, right? And so this concept is, look, just use leverage. Simple. Find your max Sharpe portfolio, use leverage, and you'll get better returns. But of course, we've talked about how volatility changes through time, right? This is a really risky proposition. If I say I'm going to use some leverage, well, how much leverage? For how long? And so what we need to do is we need to, just like we constantly measure correlation and volatility on the asset classes to create the optimal portfolio, we also need to constantly measure the volatility of that portfolio. Like that thermostat on the wall, right? The thermostat is not trying to predict what's happening in this room. As it gets colder, it bumps up the heat. As it gets warmer, it bumps up the air conditioning. We're going to do the same thing. We are going to, number one, what we've been talking about is every 2 weeks, as volatility, correlation, carry, trend, all these things change, the high sharp portfolio is going to change. We're going to get, all these dots are going to move around. We're going to get a new efficient frontier. We're going to get a new tangent point. We're going to get a new optimal portfolio. And then once we got to decide how much of that portfolio is going to be invested, or how much exposure we're going to have to leverage. And as that changes, we need to change. Because if we just decide on a static allocation to leverage, if we just say it's going to be 40% levered, and we know that the volatility changes through time. So this is an example of the U.S. equity market 12-month rolling volatility. The U.S. equity market has for this period had an average volatility of 16%, but it was rarely at 16%. Again, having your head in the freezer and your feet in the fire. In the middle, you're just right, but you have these moments of extreme event, and you've only really hit that 16% volatility profile once or twice, 4 or 5 times. Sometimes you're at 10% volatility, sometimes you're 80. By us constantly measuring the volatility of the new suggested portfolio and adjusting our exposure to it, we are able to provide and hit that risk target that you wanted, that you signed up for. And if you're an equity investor and you're okay with 16 volatility, then we can provide that for you more often. And what that looks like, going back to that transition chart, is number one, you see the different colors and the different allocations that you have. That's the change in the Sharpe portfolio. But also, we're changing our exposure. When volatility is low, we're using leverage to hit that volatility target. When volatility is high, we're reducing our exposure to leverage, and so on. Okay, so this is at 16% volatility. And what that provides, because of the high Sharpe ratio, for the same level of risk that I take for equities, I'm getting more units of return, right? So you can get a significantly higher risk profile. And like Adam said, do we expect these returns from a long-only type portfolio to persist? Probably not. Cut that in half. So maybe you're not getting 26%, maybe you're getting 12. That's still pretty good compared to what equities are likely to do over the next 10, 15 years. And we've been running this live for about a year now in our robo-advisor. And we're having a good year so far. Why? Because, international equities have done much better than domestic equities this year, and we've been part of that. We've been diversified, and we've levered up to the same level of risk that people have experienced in equities. So that's the final chart we're going to show you today. I think it's been we counted 125. This is a record even for us. I have no idea why. We just couldn't stop ourselves. We have so much to say. But I guess the things we want you to take away from all of this is, and look, it was, for me, it was eye-opening to go down this path, because the first thing is understanding that, there's going to be, we're in a situation that is pretty terrible for all of us in terms of what we can expect for traditional portfolios. In 1982, you didn't even need to be here. You didn't need to think about your portfolio in any real way. Had you just bought a 60-40 portfolio, you would have had a tremendous run. Right? This is right after a period of poor performance in the markets. And for 82 to 2000, you could just put up the sales and sail away. You didn't have to put any thought into your portfolio. You didn't have to do anything that was outside of your comfort zone. It was easy. And we are now faced with the next 10 to 15 years that are going to be hard. They are likely to be closer to that 1900 to 1921 period, that post-war period, the 70s period. And if that's the case, then we need to learn how to row, right, in this low return environment. And that means that we need to go back to old concepts that are now new, old concepts such as proper portfolio construction. What we are talking about here is not something we invented. It is something that was put together thoughtfully in 1961, 62 by Markowitz and won the Nobel Prize in the early 90s that nobody uses because you didn't need to. Because you could make all the returns you needed by 2 asset classes that you understood, U.S. equities and U.S. bonds. Today we need to think more thoughtfully about that, be more thoughtful about that, and so going global is important. We're also in a position in the year 2017 that we can get easy and cheap access to these global asset classes that we didn't even 5-7 years ago we couldn't. So we now have the technology to create a balanced portfolio if we don't feel like we have any edge in foreseeing the future or in applying any sort of factors or carry. We can simply, by taking a multi-strategy approach, multi-asset class approach, get closer to our goals. And then if you feel so inclined and you want to do the reading and you want to do the testing, and there's a bunch of online resources and cheap allocation websites that you can sign up for that'll get you access to a more thoughtful way of predicting the future of your asset classes, whether it's through trend carry in our case, which is what we like because it's more consistent, or otherwise. And then finally, when you get to that point, you're like, this is amazing, this is totally diversified, and my volatility has gone way down, and I'm going to expect that it's a 2.5 volatility and 5% rate of return. Crap, that doesn't get me there. Then you can say, okay, well, who cares? Because I can now get institutional pricing at Interactive Brokers for leverage and grab that beautifully diversified portfolio with very thoughtful rules that have very low volatility but a high return, high bang for my buck, and apply that leverage and make sure that I'm applying that leverage thoughtfully and intelligently. And if you are able to do that, now the world is your oyster, right? Now you're able to row and feel more confident that you're going to reach those return expectations that you need to maximize your retirement without necessarily taking excess return. See, the oxymoron here is that we are using leverage to reduce your risk, right? Because otherwise you will need to concentrate your portfolio in equities that have fat tails, large drawdowns, large volatility, because you need that return. Alternatively, you can reduce all that and then use leverage to have the same level of return for lower risk. Using leverage to reduce your risk. Do a lot of research on that. Don't go out and put, double up your portfolio and leverage right now because I don't want to go to jail. But again, all of this, I mean, the big takeaway is that we can't sail anymore. We need to put more thought into our portfolio. It's time to educate ourselves. You guys are probably at the 1% of the 1% of investors that actually care, which is fantastic. And I'm sure you're going to take all of this with a grain of salt and be very cynical about it. But hopefully we have enough research out there that'll help you. We have a ton of stuff on our site. We just published a paper called Skis and Bikes, the untold story of diversification that gets us along. So if you go to our website, that'll pop up. Download that. I really like that piece.
I just had a quick question. Yeah. I was wondering, several times I heard that the next 10 years are going to be rough or something. How do you predict something like that?
In the beginning of the presentation, we walked through, so let's just make it easy. Bonds have a yield of 2.5%. When you get a copy of this presentation, you'll see where the source of this is. But you can predict pretty confidently that your return for your bond portfolio is going to be around 2.5%. Right? So that's one true. And then based on current valuations for the S&P 500, depending on which valuation metric you look at, and by the way, this isn't us doing this, we have our own valuation metric, but AQR, Bridgewater, Vanguard, Jack Bogle came out and said stocks are going to be around 4% over the next 10 years based on how expensive they are right now, right? So they got to go back to the mean. If you're a 60-40 portfolio and you're getting 2% in bonds, 4% in stocks, you're going to get something that's in between that, and then that's before fees, transaction costs, and taxes. So this is where we're at. It's not pretty. It's not great. But we need to. But the thing is it over? Should I just kind of give it up and go to cash and hope for this big drawdown that's going to happen? Well, the problem is it doesn't always work that way. It doesn't always mean that you're going to have a 40% loss next month where you can buy back in and make all your money. It could mean just it goes sideways for 10, 15 years as corporate profits come out, right? So you need to when you look globally and you do the same analysis for emerging markets, you're looking at an expected rate of return of 7%. So just going global increases your expected rate of return in the next 10 to 15 years. And then you take it even further by looking at some of the factor strategies and bump up that return, and reduce your drawdowns, bump up that. So there are things you can do to improve. And that's what we need to do, but we can't coast.
Question. So with all this numerical analysis you're doing and all that, so you look at the period around 2008. The market did dive in one day in 2008. So with all the numerical analysis, there's moving averages and so on and so forth. So you rebalance every 2 weeks. So is there anything that you could, are you able to predict that when it's just starting to happen? Or do you have like a 2 week or a month delay?
Well, there's two ways to think about that problem. Number one is how quickly are we reacting to this, and are we making changes fast enough? And yeah, I mean, the 2 week period is generally enough for you to not get totally decimated, right? But that's less of the solution. More of the solution is in being diversified, in pleading some level of ignorance that, you know, if you look at 12-month trend, what you're saying is, and there's strategies out there that pick the top 2 asset classes, right? And listen, over time that works. But in that period, no way, when that top 2 had that one day where the market was down 700%, you got decimated. And that's because that system had a high level of confidence and hubris in saying that this is it. These are the 2 performing classes. I'm predicting that these are going to continue to go up, and they didn't. And so how you mitigate against that is by saying, well, okay, maybe we use that as one system. What about another system that ranks trend based on Sharpe ratio, or another system that ranks it based on the time above trend? All these 41 different systems that we use end up forcing diversification on our methodology, so that when periods where 2 of those asset classes are really doing poorly, we always have something that naturally will go up because of those foundational principles of those asset classes. Right? So this is why we worry about on-off type of quant strategies that are pervasive in this space, where you're saying, you know, if this happens, you're 100% in or 100% out. Those have a high blow-up tendency. We prefer asset strategies that transition in, transition out, have a little bit more diversification. It means that you are always going to be underperforming the most confident quant tactical strategy when things are going well, but you're not going to be blowing up when they're blowing up. So diversification is the solution to that. More questions? Wow, you guys made it. All right.
Woohoo. Okay. Oh, thank you. Thanks very much. I appreciate it. Warm round of applause for Adam and Remember to hand in your survey forms, okay? And I'm sure Adam and Rodrigo will hang around a bit, and so you can get them up with some further questions. There will be, just put them on the back table. We'll take them there. Thanks much, everybody. Appreciate it.
This is Al Zmysłowski again. Thanks for viewing the recording of the chapter's October 7th, 2017 event on Adaptive Asset Allocation, Dynamic Global Portfolios to Profit in Good Times and Bad by Adam Butler and Rodrigo Gordillo of Resolve Asset Management. On screen presently is Resolve's disclaimer. We again ask that you please review this information carefully. We'll provide a short pause here to give you time to review the slide. At this point, we'll take the opportunity to thank you for viewing this webcast recording, and we hope to see you at future chapter events. Goodbye, and we hope you have a pleasant day.